Howdy, Team 42. It's your skipper here, Darius Dale, founder and CEO of 42 Macro. Raise your hand if you would like to improve your investment results. I assume everybody has their hand up. Now, raise your hand if you would like to learn how to use macro to improve your investment results. I assume some of you put your hands down. This is about a good time to leave, but for the rest of you, we're going to have a fun journey. So stick around. We're going to teach you how to use macro effectively and efficiently to improve your investment results so that you can achieve your strategic investment objectives. So let's just hop right on into it, starting with our table of contents. This is a three-part presentation. So if you want to break it up and get some coffee or get lunch or whatever you got to do, shake your legs, all that good stuff, we'll make sure we're kind of breaking it up for you. So part one, we're going to intro you to macro. We're going to talk to you about why macro matters, what the key indicators to watch are. We'll talk to you a little bit about forecasting the liquidity cycle, forecasting the business cycle, and then we'll shift over into macro risk management best practices. And what we mean by macro risk management is actually using that information, like the business cycle, the liquidity cycle, the key indicators to watch, to actually generate actionable investment ideas and timely pivots in your portfolio to make sure that you're constantly on the right side of market risk as opposed to on the wrong side of the market risk, which is where a lot of the folks have been for the past few years. And then so we'll break that up into macro signals for traders. So this is folks who are trying to generate income and capital appreciation on short to medium term time horizons. We'll talk about macro signals for investors, which are folks who are trying to generate income and capital appreciation over medium to long term time horizons. And then we'll walk through our analysis of behavioral heuristics that we think will benefit every type of investor, whether you be a short-term investor or a longer-term investor. And then finally, we'll help you piece the puzzle together with a quick overview of our process here at 42 Macro, the things that we communicate to our clients on a daily basis, 6 days a week, in terms of piecing this whole puzzle together to keep them on the right side of market risk. So without further delay, let's just hop right into it. Intro to macro. So we'll start with why macro matters. So macro forces perpetuate dispersion across asset class. And what we mean by dispersion is just the spread between the returns of the various asset classes. As you can see here over the past year, the SPY, S&P 500 is up 21%, whereas the TLT, the 30-year Treasury bond, is only up 2%. The dollar's down 1%. Commodities are down 8%. And then you got our friend Bitcoin up here, more than doubling its value. So the reason those returns are different, obviously these are different asset classes, but what causes those returns to be different and what puts what asset on what type of top of the leaderboard or the bottom of the leaderboard, that's macro. And we'll talk about what those macro forces are as we move throughout the presentation. So macro forces perpetuate dispersion across asset classes. You can see the return of stocks versus bonds is quite disparate on the trailing 1 year look back. The return of the US dollar versus commodities, quite disparate on the trailing 1 year look back. The return of Bitcoin and gold are quite disparate, although both are up quite a bit. Gold's probably got a higher Sharpe ratio, but those returns are still quite disparate in the context of what's driving that. Macro forces perpetuate dispersion within asset classes as well. And so as you can see here, these are all the S&P 500 sectors, their trailing 1 year performance. As you can see, there's quite a bit of dispersion. So it'd be one thing if you bought the market and got that 21% return. It'd be entirely another thing differently altogether if you bought something like consumer discretionary, which is down at only plus 4.6% in terms of that return. Or if you bought what's the energy sector, which is actually lagging it down 0.6%. Those returns, those paltry returns compare unfavorably to things like communication services up 27%. You got financials up 22% as well. What else is up 26%? I want to say we got tech probably as well, up 26% as well. So, macro is the thing that causes these returns to be different. And so again, as I mentioned, we'll go through all those macro forces as we get into those throughout the presentation and how you can actually incorporate them into your investment process or rely on another investment process that actually gives you those clear and actionable signals that you need to do macro properly. Macro forces perpetuate dispersion within fixed income as well. They perpetuate dispersion within the currency market. Most recently, we saw a significant move in the Japanese yen off the lows. It was down 10% on a trailing 1 year look back basis, or kind of trailing 11-month look back, and now it's up only down minus 1.5%. And this had obviously significant impact in terms of the sharp correction we saw across risk assets and the big rally that we saw in bonds in the context of that yen carry trade unwinding. And so those are obviously all perpetuated by macro forces as well. Macro forces perpetuate dispersion within the commodity market as well. Macro forces perpetuate dispersion within the crypto market. Obviously the crypto market tends to be a highly correlated asset class, but why certain cryptocurrencies, certain tokens, particularly the meme coins and the altcoins outperform or underperform the more core tokens like Bitcoin and Ethereum and Solana. Those things, the macro forces are the reason for those for that dispersion as well. So, what are the key indicators to watch when you're talking about weaponizing macro and using it to improve your investment results? So the key indicators to watch are growth and inflation. So the starting key indicators to watch are growth and inflation. So in this chart, we just show real GDP on a quarter-over-quarter SAR basis and on a year-over-year basis in the bottom panel. A couple quick things to note about this. So this is U.S. real GDP growth. The most recent data point was 2.8% quarter-over-quarter SAR in the second quarter of 2024. If you look at the trailing 10-year mean of that time series, it's 2.6%. So that's what economists would call trend growth in the economy. It's about 2.4% when you look at it on a year-over-year basis. And then if you kind of look at it, how GDP growth grew in the period prior to the pandemic, which we would argue was kind of the last, 5 years of quote unquote normal economic conditions, it's the mean there is right around 2.5%. So you can make the case that the U.S. is kind of a 2.5-ish trend economy. Anything we're growing faster than that, we're going above trend. Anything below that, we're going below trend. And obviously, the direction of travel matters as well, as we'll talk about later. On inflation, this is the U.S. GDP deflator, which came in at 2.3% on a quarter-over-quarter SAR basis in the second quarter, came in at 2.6% on a year-over-year basis in the second quarter. When you go back and you look at the trailing 10-year mean on a quarter-over-quarter SAR basis and on a year-over-year basis, the trailing 10-year mean is 2.7% for the quarter-over-quarter SAR and 2.6% for the year-over-year. And then if you look at it relative to the 5 years prior to the pandemic, it's somewhere around 1.5 to 1.6%. So you can make the case that trends inflation in the U.S. economy is somewhere between 1.5 and 2.5%, with the mean of that being 2%. So let's call it the U.S. is, say, a 2.5% real GDP growth economy. Let's call it 2% inflation economy. So anything close to 4.5% nominal growth is sort of trend type growth, and anything above that's above trend. Anything below that is below trend. So the key indicators to watch are how growth and inflation are cycling. So the level of growth and inflation is not nearly as important for explaining dispersion within and across asset markets as the rate of change, as the direction of travel of growth and inflation. And so, based on our studies, we've identified 4 different types of regimes that growth and inflation cycles can be in when you marry them together. So Goldilocks is a situation where growth is accelerating and inflation is decelerating. Reflation is a situation where growth and inflation are accelerating simultaneously. Inflation is where growth is decelerating and inflation continues to accelerate. And then finally, deflation is where growth is decelerating and inflation is decelerating. And as you notice in this chart, we show that growth is actually a leading indicator of inflation, as we'll talk about in the business cycle section later in the presentation. So how we how we help clients actually accurately forecast these very important growth and inflation cycles is with our GRID model. GRID just stands for short for Goldilocks, reflation, inflation, and deflation. Those are the 4 regimes we just identified here on slide 18. Goldilocks is a situation where economic growth is trending higher and inflation is trending lower. Reflation is a situation where economic growth is trending higher and inflation is trending higher simultaneously. Inflation is whereby growth is decelerating and inflation is trending higher. And then finally, deflation is where growth and inflation are trending lower simultaneously. So let's unpack this model, because it's a very important model in terms of keeping our clients abreast of how the markets are likely to evolve on a medium to long-term time horizon. And so we'll start with the first row, where we just show the bottom-up macro regime determinations, which again are just these 4 observations. So what we see is, coming from late 2022, we were in a situation where the U.S. economy was in deflation for most of the second half of 2022. We popped into Goldilocks, which is growth trending higher and inflation trending lower for most of 2023, all the way into the early part of 2024. We had a little bit of time spent in deflation and inflation, which is growth kind of starting to come off the top, with inflation kind of bouncing around a little bit. In the first quarter of this year, if you recall, we had those 3 consecutive negative inflation or sort of upside surprises in inflation to start the year. We finally settled down back into reflation before landing in Goldilocks again for the month of June. And so the second row just shows our projections, which are based on our proprietary model. The third row, and so as you can see, we've had a generally decent generally decent run in terms of accurately projecting the grid outcomes for the U.S. economy. And then over here, where we show the projections, so at all times we have this model loaded live so that clients can understand what the next 12-month, the 1 year rolling 1 year forward outlook is from a grid perspective. And as you can see, we have a couple more Ds left in September, finally, before it's transitioning to inflation, which is growth decelerating on a trend basis and inflation starting to accelerate. So you can see that here on growth. You can see that here on inflation. The next line just shows the hit rate, where we show our model as the most recent data point as a 60% chance of identifying the correct grid regime observation ex ante in this process, which is more than double what you would actually experience as an investor just flipping a coin or with random luck. You have about a 25% chance of getting that conditional probability right in terms of the direction of growth and the direction of travel. So we're more than double. The model is effective by more than double you would if you were just sort of guessing. We show Bloomberg consensus projections. And so what we do here is we take the implied deltas on Bloomberg consensus growth and inflation numbers, and we push them and we transform them into implied grid observations so that we can compare our grid projections relative to Bloomberg consensus. And as you can see here, Bloomberg consensus has done a pretty decent job as well over the past kind of 1 to 2 years of projecting the bottom-up grid regime observations, although their implied projections from their Bloomberg consensus growth and inflation forecast are a little bit worse than our model at about a 49% accuracy rate relative to our 60% accuracy rate. And so if you look at Bloomberg consensus projections, they're expecting the U.S. economy to hang out in what we call bottom-up macro regime deflation, which is, again, growth decelerating and inflation decelerating on a trend basis before finally transitioning to Goldilocks in the first half of 2025. So that's where you start to see some divergence in our forecast relative to Bloomberg consensus forecast. So Bloomberg consensus is calling for growth to start to meander higher in the first half of next year while inflation continues lower, whereas we are calling for growth to continue trending lower in the first half of next year relative to our projections of inflation starting to meander higher, not accelerate markedly, but meander higher, and obviously not achieve the Fed's structural inflation target. Getting here into the second sort of panel where we show real GDP growth. So this first panel just shows how real GDP growth has been tracking. We show that in the black line here on this chart here. So just getting a sense of how the year-over-year trend in real GDP growth has progressed. We show our forecast here in the second line. We show the Z-score of our forecasts relative to the 2015 to 2019 trend to get a sense of whether and we are projecting below trend or above trend growth, because that has important implications for asset markets as well. We show our directional accuracy rate, which if you were just flipping a coin, you'd have about a 50% chance of getting growth accelerating or growth decelerating correct. Our model has a 73% directional accuracy rate, so significantly better than luck would have you. And then our average absolute forecast error, which is the average spread between our forecast relative to the observed real GDP rate that's been reported by the BEA, 69 basis points on a trailing 10-year look back. Those numbers are all compared to Bloomberg consensus, where you show the Z-score. We also have the Z-score in the forecast for Bloomberg consensus as well, so we can compare how our projections are likely to evolve relative to consensus, because that's also a very important thing you need to know. So when you think about growth and inflation cycles, you need to know, is growth at high or low? Is it accelerating or decelerating? And is it above or below consensus? You need to get all three of those things right if you want to consistently stay on the right side of market risk from the perspective of your bottom-up regime forecasting. And so, as you can see, our model is a little bit better than Wall Street economists' consensus in terms of the directional accuracy. Theirs is 65% versus ours at 73%. The average absolute forecast error for the Bloomberg consensus forecast is 71 basis points relative to our 69 basis points. And then finally, headline CPI, we show all those same statistics for headline CPI. The thing I call out is that our model is a little bit better than Bloomberg consensus as well. And again, this is Wall Street economists consensus. So the guys at Goldman, Morgan Stanley, Wells Fargo, JP Morgan, et cetera, when you put all their forecasts together on a median basis, their model has a 66% directional accuracy rate and a 31% average absolute forecast error relative to our model, which has a 72% directional accuracy rate and only a 27% average absolute forecast error. And both of those are trailing 10-year look back. So this is a very important tool in terms of helping clients understand Where are we in the growth and inflation cycle? Where are we relative to consensus with respect to our projections for growth and inflation? And how might our bottom-up grid regime forecast diverge from what's expected by the market? Because that's where the market risk and the market opportunity lies. In fact, you can just say risk, because in our opinion, we think risk works in both directions. None more so than the upside risk we've been accurately forecasting since going back to January of 2023. So the 42 macro grid model is effective across geographies. So we just showed the United States grid model. Macro markets tend to anchor on the US grid observations. I mean, just look back at the Goldilocks sequence that we've observed here, and then a little bit of a reflation prior to transitioning back to Goldilocks. And then obviously most of 2022 was inflation, followed by a transition to deflation in late 2022. That deflation was actually welcomed by the markets at the time, obviously, given that inflation was the dominant market risk back then. So this model is effective across geographies. It's effective in certain economies more than others. But for all the main economies, the ones where we all have assets allocated to, like China, Europe, Japan, the UK, global assets, and obviously the US, that's where the models tend to be most effective in terms of forecasting growth and inflation, and actually using that to build defensible portfolios for swings and inflections and also trends in these growth and inflation cycles. Why does this model work? Well, there's, with respect to the grid model specifically, there's one element of the process that allows this process to work and has really worked across decades, dating back to the time when Ray Dalio founded Bridgewater and Bridgewater Asset Management. So regime segmentation. So I'm just going to read a quote from his book, The Principles. This is from page 70 of his book, Principles. I want to say it's his first book. I knew which shifts in the environment cause asset classes to move around, and I know that those relationships have remained essentially the same for hundreds of years. There were only two big forces to worry about: growth and inflation. Each one could be rising or falling. So I saw that by finding 4 different investment strategies, each one of which would do well in a particular environment: rising growth, rising inflation, which is reflation in our nomenclature; rising growth with falling inflation, that's Goldilocks in our nomenclature, and so on. I could construct an asset allocation mix that was balanced to do well over time while being protected against unacceptable losses. So we stand on the shoulders of giants here at 42 Macro Research. We're not in the business of reinventing the wheel. We are in the business of making the wheel perform better in terms of producing superior results for our client portfolios. And so this is, that regime segmentation concept is one of the reasons why Bridgewater Asset Management grew to being the largest hedge fund in the history of hedge funds. I want to say at its peak, it was managing over $200 billion of outside capital. And so this system obviously works. It's one of the, and obviously the returns over time have really proven to demonstrate that this system has worked, as have we here for our clients at 42 Macro. So growth and inflation are not the only macro cycles that influence asset markets. You can now cast the rest of those cycles with the 42 Macro weather model. And so what the 42 Macro weather model is designed to do are 2 things. One, keep clients abreast on the trends and inflections in the key macro cycles that matter most to asset markets. So that's growth, that's inflation, that's employment, that's corporate profits, that's fiscal policy on the real economy side. And on the financial economy side, that's liquidity, it's credit, it's interest rates, and then it's fear and greed. And we measure fear and greed through the lens of positioning across defensive assets and risk assets. So let's walk through how these cycles are currently performing and what they're essentially signaling for asset markets on a medium-term time horizon. And so right now, GDP growth is actually trending sideways when you measure it on a monthly basis. It's expected to inflect lower and trend lower by 130 basis points over the next 12 months. Headline CPI is decelerating, is expected to continue decelerating by 60 basis points over the next 12 months. The unemployment rate is currently accelerating, is expected to inflect and trend lower by 10 basis points over the next 12 months. And again, these are Bloomberg consensus estimates. We're interpolating the implied change in growth, inflation, and unemployment by subtracting the current estimates from the next 12-month estimate, the 1-year forward estimate for each of those variables. Then we compute implied sales growth rate for the S&P 500 amongst Bloomberg consensus forecast, which is currently trending higher, that number. We impute a implied earnings growth rate for Bloomberg consensus forecast, and those numbers are trending higher, and those are 3.2 and 5% respectively. If you look at, and so next 12 month, rather 1 year forward sales and earnings growth estimates. If you look at the sovereign fiscal balance to nominal GDP ratio, that number is trending higher, which means the budget deficit is getting smaller on a trend basis as a share of nominal GDP. The dollar on a real effective exchange rate basis is trending higher, which is consistent with a negative fiscal impulse. So that is trending higher as well. So shifting gears to the financial economy cycles here on the right, 42 macro net liquidity, something we'll talk about later in the presentation. That's U.S. liquidity. That is currently trending lower. Global liquidity is currently trending higher. We'll talk about our global liquidity proxy as well in the forecasting liquidity section. The domestic credit growth is trending lower at only 1%. Global credit growth on a PPP weighted basis is trending lower at plus 3%. Interest rates are trending sideways in terms of the benchmark policy rate by the Fed. The 2-year nominal yield spread relative to that benchmark policy rate are pricing in quite a few rate cuts. That's a pretty substantial degree of rate cuts on a 2-year basis, and that number is trending lower, so pricing in more rate cuts on a trend basis. And then finally, with respect to our aggregated U.S. dollar and U.S. Treasuries positioning indicators, this is a non-commercial net length divided by total open interest in the combined futures and options markets for each of these asset classes. And so for the respect to the dollar, we're tracking aggregated dollar positioning. So this is all the major currencies and gold relative to the US dollar. The dollar is actually an extreme net short position right now at minus 17% non-commercial net length divided by total open interest. The Treasury aggregated positioning across the Treasury's curve is minus 18% net short. That's a neutral signal for now. And our aggregated positioning across commodities is minus 1% net short. That's an extreme bear position by consensus. And then aggregated positioning across equities, all the equity instruments that the CFTC keeps track of, is plus 1%. That is currently a neutral signal. And so, as I mentioned, there's 2 ways in which investors are using our macro weather model. One is to keep tabs on the trends and inflections across all these key macro cycles that matter most to invest in asset markets. The second thing that it does is help investors actually predict with math how each of those cycles and really the constellation of the current trends in each of those cycles are likely to contribute to asset market performance on a medium-term time horizon. So each of these component features, the 20 component features we just highlighted, contributes independently to each asset class. The rolling 3-month forward return outlook projected for each asset class. So for now, it's got a neutral signal for the stock market, a bullish signal for the bond market, a bullish signal for the US dollar, a neutral signal for commodities, and a bullish signal for Bitcoin. So what do those signals actually imply? The neutral signals imply that investors should be expecting baseline type returns in that asset class based on the current constellation of trends in these real and financial economy cycles over the next 3 months. That the bullish signals imply that investors should be expecting above baseline, above median returns in those asset classes based on the current constellation of these real and financial economy cycles. And then obviously, if we had a bearish signal to highlight, it would suggest that investors should be expecting below median returns in those asset classes over the next 3 months. So it's a very powerful tool. It helps investors, again, stay abreast of the key macro cycles that matter. I know we spend a lot of time as investors listening to podcasts, watching financial TV, consuming financial research, hanging out on Twitter, hanging out on Discord. Everyone's doing it. We're all doing it. Investing is a social game. It will never not be a social game. AI be damned. But at the end of the day, what we all are talking about are one of these 20 component features in the page, or we're talking about one of those 5 asset classes, generally speaking, in the middle of the page. And what this model does is it helps investors to have real, salient, and consistent signal from all those discussion points that we're hearing on and reviewing on a daily, weekly, and monthly basis. So in terms of how effective this model is in terms of helping investors stay abreast of those market cycles, as I mentioned, what the bullish signals imply is that investors should expect above baseline type returns in the asset class over the next 3 months. Neutral signals imply investors should expect baseline type returns in the asset class over the next 3 months. And then finally, the macro weather model, the bearish signals imply investors should expect a below baseline type returns in the asset class over the next 3 months. And so what each of these charts represents are the historical progression of weather model signals for that particular asset class. And then the back test down in the second half of the chart just shows if you were using the macro weather model as a pure standalone trade signaling tool, whereby an investor would go long $1,000, $100,000 of invested on January 1st of 1998, and you go long the exposure at the close of a subsequent trading day following a fresh bullish signal. It cuts the position in half at the subsequent trading day following a fresh neutral signal, and then it cuts the position to zero on the subsequent trading day following a fresh bearish signal, and that process works in reverse. If you were just doing that process over and over again throughout the duration of this out of sample back test, you'd have a plus 2.6 Sharpe ratio, which is the return minus the risk-free rate divided by the volatility of the asset, 2.6 Sharpe ratio in trading equities using this signal, whereas the actual Sharpe ratio of the equity market, of the stock market, of the U.S. equity market was only 0.9. The macro weather model is not as good as being naked long bonds in a raging bond bull market in terms of the great moderation. But obviously, as you can see in recent months or recent years, it's done a phenomenal job, particularly in 2022, keeping clients on the right side of bond market risk. In terms of the US dollar, the Sharpe ratio of using this macro weather model in terms of incorporating all the key macro cycles that matter in the financial economy side and the real economy side into these actionable signals, you'd have a Sharpe ratio that's 6 times what you would experience just being naked long the US dollar throughout the duration of that sample backtest. The Sharpe ratio for the commodities asset class is more than 3 times larger than the macro weather model Sharpe ratio is more than 3 times larger than the Sharpe ratio of the asset class for commodities at 1.7 versus 0.5. And then finally for Bitcoin, this is where it gets really Looney Tunes. I've said this for years, specifically since 2020, that Bitcoin might be the most macro asset in the world. It's the asset that has the most amount of influence, where macro has the most amount of influence on its price trends. And this is why our model, the macro weather model, has been as good, if not better, than anybody I've seen trading Bitcoin on this with respect to this out of sample back test. So these are Looney Tunes Sharpe ratios. Obviously, the Bitcoin asset class itself has a Looney Tunes Sharpe ratio since inception of about 57,000. Well, our Sharpe ratio in this this out of sample back test is 600,000. Now, obviously, anytime you see numbers like this, you understand that there's obviously going from 0 to 75,000 is going to create some ridiculous back tested performance. But on a go forward basis, what I do think it shows that if you use macro to trade the crypto cycle, you can have much superior results than investors who are not incorporating macro. And I suspect most investors are incorporating macro into their thought processes around when they buy, when they sell, and how much they buy and how much they sell in the crypto asset class, just as they're doing in other asset classes. But what this presentation is designed to do is to get you to start focusing your time and attention and allocating your focused budget appropriately on the things that actually matter to determining dispersion within and across these asset classes, as opposed to the narratives that we're constantly being bombarded with across all the various areas in which we consume financial media. So skipping ahead, so in terms of how this model works, in terms of the macro weather model. So what this model, this is a regime segmentation model that projects a unit of excess return dispersion into those composite signals in order to generate those rolling 3-month forward projections. And so how the model actually works, we'll pick on real GDP as an example. What it first does is calculate the rolling 3-month forward baseline for each asset class. The rolling 3-month forward baseline for the stock market is 3%. The rolling 3-month forward baseline for the bond market is 1.4% on a total return basis. The rolling 3-month forward return for the US dollar is 0.1%. On the rolling 3-month return baseline is for the commodities asset class is 0.8%. And then the rolling 3-month forward return for the Bitcoin asset class is about plus 17%. So for any asset, so going back to the signals that we observed for each of these component features, what this model is designed to do is push one of the 3 back tests into the overall signal. And so for now, real GDP growth is currently trending sideways. So right now it's projecting the unchanged back test into the overall composite signal that we are showing in the middle of this page here with respect to those 5 asset classes. And so what does that mean in terms of real GDP specifically? Well, it's a negative excess return relative to baseline for growth for stocks. It's a positive excess return relative to the baseline for bonds. It's a negative excess return relative to baseline for the US dollar. It's a negative excess return relative to baseline for commodities. And it's a very positive excess return relative to an already very positive baseline for Bitcoin. Well, the consensus next 12-month real GDP delta is negative, and so it's projecting a negative excess return for stocks, a negative excess return relative to baseline for bonds, a positive excess return relative to the baseline for the dollar, and a negative excess return relative to their respective baselines for commodities and gold. Inflation is currently trending lower, so it's projecting the decelerating excess return back test. The consensus next 12-month headline CPI delta is negative, so it's currently projecting that excess return back test into the overall composite signal. The unemployment rate is currently trending higher, so it's projecting this excess return baseline to the composite signal. The unemployment rate delta that's implied by consensus over the next 12 months is currently lower. It's falling, so it's projecting the falling excess return back test into the current composite signal. The implied sales growth rate for the S&P 500 is trending higher, so it's projecting this excess return back test. The implied earnings growth rate for the S&P 500 is projecting this excess return back test. And I'll pause just to highlight something. As you can see, not all the excess return projections that are being fed into the composite signals are the same. And what that means is that not all the features in the model are weighted the same. The features are weighted as much as they've historically contributed to dispersion within and across those five asset classes. And so if a signal, when it switches from regime 1 to regime A to regime B, or accelerating to unchanged to decelerating, we notice that some signals, some features in the model have more of a signal, which means that we should be paying more of our focus budget to paying attention to how those trends and cycles are evolving, and less to things like sales and earnings growth, which have much smaller excess return dispersion profiles in their respective back tests. Certainly not as strong as things like inflation and growth deltas and the trends in growth and inflation themselves. Keeping it moving here, sovereign fiscal balance to nominal GDP ratio is trending higher, so it's projecting the rising excess return back test into the composite signal, as is the U.S. dollar real effective exchange rate. 42 macro net liquidity, that's U.S. liquidity, is currently trending lower, so it's projecting the falling excess return dispersion back test into the composite signal. The global liquidity proxy is trending higher, so it's currently projecting the rising excess return back test into the composite signal. So this is about it sounds complicated, but it's about as simple as it gets. When liquidity is trending higher, stocks outperform their baseline by 130 basis points on average. When liquidity is trending higher, bonds outperform their baseline by 10 basis points on average. When liquidity is trending higher, bonds outperform, the U.S. dollar outperforms its baseline by 20 basis points on average. When liquidity is trending higher, commodities outperform the baseline by 20 basis points on average. And then the liquidity is trending higher, Bitcoin outperforms its already ridiculous baseline of plus 18% by an additional 640 basis points on average. And so this is the amount of excess returns that are being contributed to that overall composite signal there in the middle of the page. The credit growth is trending lower in both instances, both domestically and globally. The benchmark policy rate is trending sideways. The 2-year nominal yield spread relative to that benchmark policy rate is falling on a trend basis and projecting rate cuts. The rate cuts part is less relevant. What matters to asset markets is the movement of these signals, the movement of the cycle, as opposed to where you are in the cycle. Where the cycle is headed has the most explanatory power in terms of where markets are headed. Where markets are matters to where you are in the cycle. Where markets are headed matters to where the cycles are headed. So you have to, make sure when you're thinking about investing, you always want to make sure that different conditions are you're appropriately assigning the proper conditions to the states of things that you're analyzing things in. You want to make sure that stock and flow are not being intermixed when you're talking about projecting where markets and the economy are headed, and you want to make sure that your level is not necessarily being intermixed with the rate of change, which is the change in the level, or the second derivative of the level. And then finally, with respect to aggregated positioning in the U.S. dollar, I want to say is an extreme bearish position right now. Aggregated positioning in the treasuries market is neutral. Aggregated positioning in the commodities asset class is an extreme bearish position right now. And then finally, aggregated positioning in equities is neutral. And so one of the things I love most about this macro weather model, and one of the reasons that our clients really appreciate it in terms of helping them, kind of stay on the right side of short to medium term market risk, is because it's super dynamic. We don't wake up every day and say, okay, well, growth has to be lower and consensus has to be projecting it to be lower, or inflation has to be trending lower, or must be trending higher, or consensus has to be expecting it to trend lower. We don't wake up guessing or trying to forecast these things. We're telling you that there is information in analyzing the trend. Now, there is signal in analyzing the trend based on these out of sample excess return dispersion back tests. And so I want to make sure investors are really aware that, forecasting is an important part of investing, but I think it's an oft overused part of investing relative to just knowing where the heck you are at any given time. Knowing how these cycles are evolving at any given time actually has a tremendous amount of signal that I don't think the average investor is weaponizing enough in terms of producing superior investment results on their portfolio. And one of the reasons the 42 macro weather model works is because it relies on Bayesian inference. It doesn't wake up saying growth has to be X or inflation has to be Y or liquidity has to be going up or liquidity has to be going down or positioning has to be extreme in this direction or that direction. It doesn't wake up trying to predict those things. It wakes up and observes those things. And this is an important quote from one of my favorite books. Or as you can tell, these are probably three of my favorite books in the world besides the Holy Bible. Being number one, obviously, but Thinking Fast and Slow, obviously, a seminal work. If you have not read these three books, obviously, I would pause this right now and go download them on audiobook or at the bare minimum, buy them on Amazon and then press unpause once you're done doing that, because you're going to learn a lot as a human and as an investor once you review these materials. But, in terms of summarizing some of the key takeaways from these materials, specifically with respect to the macro weather model, is this concept of Bayesian inference. And the concept of Bayesian inference is updating your assessment of the probability of certain outcomes based on constantly reviewing new information, new relevant information. Not all information is relevant. What color my tie is no bearing on where the markets are going to be tomorrow. But what the Fed does with the policy rate might, or if it's raining tomorrow, may not have any bearing on where the stock market's going to be tomorrow. But where if we had an inflection in the trend in U.S. or global liquidity, that might have an important distinction. So you must understand, what the key cycles are, and hopefully we did a good job of explaining the importance of those, each of those 10 key macro cycles and the 20 principal components we've identified to help clients stay on track of those. But getting back into this quote, very important quote, one of the most important quotes you're ever going to hear. So I'll stop and read it slowly. Subjective confidence is a judgment. Sorry, my apologies. Let me reply to that. I want to do my man, Dave. I want to give proper credence to our friend Danny Kahneman and Amos Tversky, two of the smartest people and most influential people in the context of behavioral economics ever. So let me pause and reread that. Subjective confidence in a judgment is not a reasoned evaluation of the probability that the judgment is correct. Confidence is a feeling which reflects the coherence of the information and the cognitive ease of processing it. It is wise to take admissions of uncertainty serious, but declarations of high confidence mainly tell you that an individual has constructed a coherent story in his mind, not necessarily that the story is true. And so in my opinion, I think that's one of the most important things you can learn as an investor in this world of, for lack of a better word, bear porn and loud headlines and, fancy buzzwords like liquidity. I mean, if you say liquidity in the title of a YouTube video, you're going to get 10, 20,000, at least the number of people watching, probably 100,000 or more. If you say recession in a YouTube video, probably a little bit less now because so many bear porn purveyors have been burned by their inability to help their clients make money on the long side of assets. But, there are certain buzzwords that trigger feelings in us. And one of those things that causes feelings in us is when we hear someone go, they're highly convicted about an outcome. And the reality is, according to the years and years, the decades of behavioral economic studies, constructing studies, analyzing the data, what they determine is that confidence has no bearing on the probability of an outcome occurring. Confidence does not increase your accuracy rate of forecast. Confidence just means you understand how the forecast is generated better. And so that's all it means. And so if you learn nothing in the first 36 slides of this presentation, shame on you. But if you didn't, I would posit to say that's one of the most important things you're probably going to learn, at least in this first part of the presentation. So let's keep moving here. So we'll talk about, we alluded to this earlier, forecasting the liquidity cycle. Liquidity is a very important a dynamic in terms of explaining dispersion across asset markets, maybe a little bit less so within asset markets, but certainly displaying the general direction of asset markets and how they're relating to each other. Liquidity has been an increasingly important element in that discussion. So let's just hop right into it. So asset markets are co-integrated with global liquidity. That means that their time series are stationary when related to each other. So that's a very fancy way of saying that if liquidity is high, it's very likely that growth is going to be high. If liquidity is low, it's very likely that growth is going to be low. Or sorry, not I misspoke. Not growth. Markets. If liquidity is high, markets are probably going to be high. Liquidity is low, markets are going to be low. And so what we try to do here for clients is help them understand swings, trends, and inflections in the global liquidity cycle. And the primary tool we use to help them do that is our global liquidity proxy. And what the global liquidity proxy is the aggregated sum of the global central bank balance sheet. And so this is the sum of the US dollar sum of all the major central bank balance sheets in the world, the top 10, their country's broad money supply on a US dollar basis, their FX reserves minus gold, so the liquid FX reserves, and then we divide that by the log of global treasury bond market index volatility as a proxy for the influence of the length of collateral change in the repo market and also the size and scope of collateral haircuts in the repo market. So obviously, as bond market volatility rises, you have less repo activity, more costly repo financing, and you tend to have a decline in global liquidity. And so the blue line in this chart just shows the time series of the global liquidity since dating back to 2006. The red line is the S&P 500. The Bitcoin orange line is Bitcoin. The Ethereum purple line is Ethereum. The black line is the Bloomberg U.S. Treasury Total Return Index. And then the green line is the U.S. Treasury Corporate Return Index. And as you can see, when you see drawdowns in liquidity here, you tend to have drawdowns in asset markets. Drawdown liquidity in 2013, you had a drawdown in the bond market. Drawdown liquidity in 2015-16, you had a drawdown in both the stock and bond markets. Drawdown liquidity in 2019-2020, obviously had a big drawdown in both the stock and bond markets, at least the bond market temporarily, and then obviously had a big drawdown liquidity in 2022, which led to a significant drawdown in both the stock and bond markets. I want to say on a combined basis, the drawdown we saw in the stock and bond market in 2022 was, in fact, the largest, I think, drawdown we've ever seen in those two asset classes on a combined basis, or I think it was probably the worst since going back to the Great Depression. It's one of those two. I can't recall off the top of my head, but as you know, as you can see, this is one of the biggest, steepest drawdowns we ever saw in our global liquidity proxy, and it was very consistent with what we saw in the stock and bond markets as well. Since the global financial crisis, risk assets have corrected or crashed for only two reasons. Number one, global refinancing air pockets, which means that you had a drawdown in the total amount of non-financial sector debt, which means you couldn't, the borrower, the entities that had previously borrowed were unable to get their prior leverage refinanced. You saw an actual decline in the overall nominal stock of total non-financial sector debt. And so that's reason number one. And reason number two is declining global liquidity. Volmageddon was the lone exception. It's the only time since the global financial crisis began where we had a drawdown in asset markets that wasn't caused by one of two dynamics: a global refinancing air pocket and a drawdown in global liquidity. So in this chart, we show the world total non-financial sector debt on a nominal basis. That's $232 trillion. We show our global liquidity proxy, as we highlighted earlier. That formula is down there in the footer there. And by the way, as you're watching this presentation, reviewing this presentation, definitely make time to review the words in the footer of each slide as you're watching this presentation, because there's a lot of extra information that helps you understand and explains the charts that you're seeing on the screen. We're not going to have time to go through every single footer and explain every single chart to a T. So I just want to make sure that you're aware that there's a lot of information down there in the blue footers down on each slide. So keeping it moving, going back to the S&P 500 in the red line. And as you can see here, with the black dotted lines in this chart show are instances where we had either a global refinancing air pocket, a drawdown in world total non-financial sector debt, or we had a drawdown in liquidity, as you saw my apologies. The black dotted lines in this analysis correspond to drawdowns of consequence in the S&P 500. So in 2008, 2009, obviously the global financial crisis, the S&P was down, I want to say 58%. We had a 16 or 17% drawdown in the middle of 2010. We had a 20% drawdown in 2011. 215 back-to-back 15% drawdowns in late 15 and early 16. Volmageddon was a minor drawdown, but it was pretty important in terms of setting the stage for the bigger drawdown in terms of 2018. We saw a 20% drawdown in the Q4 of 2018. We saw a obviously 35% drawdown in the stock market in 2020, and then obviously a 25-ish percent drawdown in the stock market in 2020. In 2022, and then in summer 2023, I want to say we had a 10 to 15% drawdown as well. So as you can see, where each of those black dotted lines are, kind of rising vertically from those circles I just drew, there was either a global refinancing air pocket, or a decline in global liquidity, or both. And so I'm circling each of those outcomes. As you can see here, there was either a decline in global liquidity or a global refinancing air pocket, or both in each instance. And so, as you can see, if you understand how the global debt cycle works, and then more importantly, how liquidity feeds into the global debt cycle, and in terms of either perpetuating it to produce positive results in the economy and financial markets, or causing more negative results, or more negative results than would otherwise would occur in terms of any sort of decline in liquidity. And so we'll keep it moving here. So we use this model here, our 42 macro global liquidity monitor, to nowcast the key macro cycles across the geographies that contribute to that global liquidity proxy and their likely influence on asset markets, so we can understand how are the economies performing in the world and across the regions, so that we can understand whether or not they are likely to continue contributing to an uptrend or a downtrend in liquidity. And once we start to see certain large economies, which are more influential than others, start to inflect their trends, it'll give us a leading edge on where liquidity might be headed globally from there. So I hope you read this table. So it's organized by growth, inflation, and policy, with liquidity sort of being in the policy bucket there. So it's organized by several factors. So within growth, we have composite PMI as the best kind of gold standard leading indicator for most of these economies. We have the consensus real GDP expectation. That's a blend of the current year and next year. So it's a kind of a proxy for what consensus thinks the general level of growth an economy can achieve over kind of a short to medium term time, or a medium to long term time horizon. And then economic surprise indices for each of those economies, so that a negative value indicates that there is a trend of negative economic surprises for that particular economy, and a positive value indicates that there is a trend of positive economic surprises for that economy. Headline CPI on a year-over-year basis for inflation, core CPI on a year-over-year basis for inflation. We show the consensus general headline CPI expectation, so very similar to the real GDP growth expectation. That is the general level of growth, a blend of the current year and next year estimate. Inflation surprises. And then we show the consensus nominal GDP growth expectation, which is just the sum of the general inflation expectation plus the general growth expectation. We show our liquidity proxy, which, as I mentioned earlier, is the central bank balance sheet plus raw money supply plus FX reserves minus gold, divided by the log of bond market volatility. And so we maintain liquidity proxies for each of these economies that contributes to the overall global liquidity proxy that you see here in the top panel. We show the benchmark policy rate, the fiscal balance as a percent of nominal GDP, the current account as a percent of nominal GDP, and then the real effective exchange rate as a percent of nominal GDP. And then we have systematic trade ideas that we'll talk about secondarily, but let's help you continue to figure out how to read this table and start to use it as a tool to anticipate trends and inflections on global liquidity. So what we show on the delta is just the trailing 3-month momentum of the time series. So, for example, the composite PMI for the global economy is trending higher at 52.5. The trend, so the level is obviously the level, and then the trend is the current observation as a z-score on a trailing 10-year basis for that particular time series. And so it gives you a sense of what's the level of the time series. Going back when we talked about growth inflation earlier, what is the level of the time series? Is it above or below trend? And what is the direction of travel? And I would argue it's probably in reverse order in terms of the most important information for asset markets. So the direction of travel is the number one thing we need to understand in terms of forecasting any of these variables, or at the bare minimum, just understanding how they're currently trending so that we can make more informed decisions in our portfolios, followed by whether it's below or above trend, because that has important implications to asset markets as well. And then relative to consensus. How are the levels that we're projecting relative to consensus? Are they above or below consensus expectations? So So getting into sort of using this to produce systematic trade ideas. So for economies where the general level of growth expected by market participants is rising, and you have a trend of positive economic surprises, which means that general level of growth is likely to continue trending higher over the medium term, i.e., the positive economic surprises are causing economists to positively revise up their growth and earnings expectations of that economy. The model will generate a positive systematic trade idea for that country's stock market. If the opposite is true, whereby an economy like Japan has a declining consensus real GDP growth expectation and negative economic surprises that are pulling it lower over time in terms of economists' GDP and earnings expectations, it'll generate a negative signal. So currently today, Australia meets that condition, as does Canada, as does Japan, as does the United States. With respect to the systematic trade ideas in the bond market, if an economy has a declining level of general expectation of inflation on a blend 1 year and 2 year basis, and you have negative inflation surprises on a trend basis that are likely to continue pulling those inflation expectations lower over time, the model will generate a bullish systematic trade idea for the country's bond market. So currently China, India, Switzerland, and the United States meet that condition, whereas in the United Kingdom, the opposite is true. And then finally, in economies where the general level of nominal GDP growth is expected is trending lower and the policy rate is trending lower, then you have a negative just systematic trade idea on that particular currency. The Chinese yuan has been one of the worst performing currencies in the world, and those dynamics have persisted for quite a while here in this model. And you have the same dynamic with respect to the Swiss franc. And so these systematic trade ideas, when taken into consideration, you can sort of see if there's a lot of up arrows in the stock situation for a particular economy. We understand that the growth dynamics are improving in such a way that makes it unlikely that central banks supply liquidity for that asset market, but it means it very positive, makes it very likely that the private sector supplies liquidity in that particular geography. In an economy where we have a lot of up arrows for the bond market, that tells you that inflation dynamics are moving in a way that suggests central banks are likely to supply liquidity over the medium term for that particular economy. And if they're moving in you have a lot of down arrows that tells you there's a collection of economies where central banks might be stepping on the brakes with respect to supplying liquidity. And then finally, situations where you have negative currency systematic trade ideas. Those are economies where you would expect the central bank to actually chase falling nominal growth expectations lower with incremental policy easing, which is obviously supportive of global liquidity, and vice versa. If we had situations where central banks are likely to continue chasing positive revisions to growth higher on a nominal basis, that suggests that liquidity from central banks in that region is likely to contract. And so one final thing I'll say on this concept of liquidity specifically, liquidity doesn't just come from central banks. It doesn't just come from the private sector. It doesn't just come from the official reserve sector either. It comes from all three. And it's very important that you understand how the private sector generates liquidity through savings and profits, how the public sector generates liquidity by running deficits and monetizing those deficits. And you also understand how the foreign official reserve sector generates liquidity through trade flows. Those are all different ways in which global liquidity can rise and fall. And then when you layer on the repo market component in terms of the value of collateral and how often a single piece of collateral is being used to collateralize leverage across the global financial system, all those things are very important. And so there's a lot of stuff to monitor and keep track of. And if you were to unpack this table into a different time series, you'd have about several hundred time series to generate this table. And so that's obviously not useful. And so what we do here is just make it very clean, consistent with up arrows. As you can see currently, global liquidity is trending higher. Liquidity is trending higher in Australia. It's trending high. It's trending lower in Brazil. It's trending higher in Canada. Trending higher in China. It's trending higher in the Eurozone. It's trending higher in India. It's trending higher in Japan. It's trending higher in Switzerland. It's trending higher in the UK, and it's trending lower in the US. And so that's a good concoction in the terms of the general weights of liquidities. Most countries are experiencing a positive uptrend in liquidity right now, and that's why the global liquidity proxy, which is the sum of all those individual country liquidity proxies, is currently trending higher now. So we refresh this table. As you can see here in top right corner of this from today, we refresh this table 6 days a week for clients in 42 Macro. This is a very important tool in helping our clients peek around the corner and monitor and spot in real time inflections in the liquidity cycle so that they can reposition their portfolio to take advantage of those inflections, either to the upside or downside in terms of market risk. So what leads global liquidity over the medium term? So it's very helpful to know what the current trends are and what they're likely to be on the short to medium term time horizon as a function of the systematic trade ideas there on the right. But we can also forecast global liquidity based on our analysis of what the leading indicators are of global liquidity. So in terms of what we found that best correlates to global liquidity on a 3-month leading basis and on a 6-month leading basis, it's stocks, it's crypto, it's the US dollar, it's currency volatility, it's interest rates, it's fixed income volatility, it's growth, it's inflation, and it's unemployment. And so what this chart on the left shows the trailing 10-year correlation of key leading indicators of the year-over-year rate of change of the 42 macro global liquidity proxy. So we take our global liquidity proxy that we show here, the blue line in these charts, and we analyze that on a year-over-year rate of change basis, and then we correlate each of these features to that derivative time series to identify what actually correlates to global liquidity with a 3-month lead and a 6-month lead. And on the chart on the right here shows the Z-scores of the latest values of each of these indicators. So the Z-score of the year-over-year rate of change in the stock market is currently on the trailing 3-year look back is plus 0.4, and on a trailing 10-year look back is plus 0.2, and so on and so forth. So we can use this information to actually build a model that actually tells us, okay, where should we expect liquidity to head on a 3 to 6 month forward basis? And that's and so we'll get to that punchline in a few slides, but I'll kind of cycle through these slides to give you a sense of how those correlations are, how they progressed over time. So right here on slide 42, we show that stocks and crypto are reflexive, emphasis on reflexive. They're reflexive leading indicators of global liquidity. And what I mean by reflexive is obviously stocks and crypto are led higher or led lower by global liquidity, but that lead in global liquidity is not a one unidirectional relationship. It's not just liquidity makes stocks go up and liquidity makes crypto go down. It's if stocks and crypto are going up, when someone sells, if stocks are rising in price and appreciating, that means the total market capitalization is rising. And so if I'm an investor and I sell a unit of share, and by the time if I sell it and it went up 10%, let's just say the total world market capitalization is $100 trillion, and it goes up by 10% in a year, and we all sell to buy bonds. Well, there goes $10 trillion of liquidity to to buy bonds with. That's $10 trillion of liquidity that came out of nowhere. And so obviously, if everyone sold stocks all together, we're not going to be able to book that 10% return. But you get the point. So as stock markets appreciate, as the crypto market appreciates, those when folks make sales in those markets, it does contribute to rising liquidity, and vice versa. As stock markets are depreciating and crypto markets are appreciating, it does contribute to a decline in liquidity, because when folks are making sales, they're making them at lower and lower prices, which means they have less and less liquidity on the other side of that sale to reinvest into other assets or to push into the economy, either or. So this chart on the left shows the year-over-year rate of change of the 42 macro global liquidity proxy. In the black line is the same in each of these charts you're going to see. The blue line is the global stock market, the stock market capitalization on a year-over-year rate of change basis. Chart on the right just shows Bitcoin on a year-over-year rate of change basis relative to global liquidity. The US dollar and currency volatility are counter-cyclical leading indicators of global liquidity. So what does that mean? Counter-cyclical just means it's moving in the opposite direction of global liquidity. So dollar up, liquidity down, dollar down, liquidity up. Same thing with currency volatility. And the interest rates and bond market volatility are counter-cyclical leading indicators of global liquidity as well. So interest rates go up, liquidity down. Interest rates go down, liquidity up, and vice versa. And as well as you can see the same dynamic here with the bond market volatility as well. So be aware of that. Global growth is a cyclical leading indicator of global liquidity. So when global growth goes up, you tend to see liquidity rise. And vice versa, when it's falling, you tend to see liquidity fall. And global inflation is a counter-cyclical leading indicator of global liquidity. When inflation is rising or is very high, liquidity tends to be falling and low, and vice versa. And then finally, global unemployment is a cyclical leading indicator of global liquidity. global debt is a structural leading indicator of global liquidity. So let's talk about unemployment first. So what does that mean is unemployment rises, you tend to see liquidity rise on a short, medium term time horizon as a function of that. When unemployment falls, you tend to see liquidity fall on a short to medium term time horizon. So, again, all of these correlations that we highlighted in slide 41 here, these are done with 3-month lead and 6-month lead to get a sense of how well do they actually predict the rate of change, the direction of travel of global liquidity. Finally, the chart on the right here on slide 46. So each of those features that we just highlighted are medium-term predictors, of leading indicators of global liquidity. They help you identify what the likely path of liquidity might be over the next 3 to 6 months, based on the combined change across all those variables. The chart on the right here is shows that global debt is a structural leading indicator of global liquidity. And this is, I'll take a second to highlight Raoul Pal's, our friend Raoul Pal's Everything Code video, one of the best videos I've ever seen in terms of trying to educate the masses on how to use macro to improve your investment results. If you haven't seen that video, I highly recommend you check it out. I myself learned a decent amount in that video. And one of the things that I learned from reviewing that analysis is that his Everything Code, which shows that global debt on a lagged basis is highly correlated with global liquidity. And so we did a big deep dive empirical study to confirm that using not just global debt, but with hundreds of US and global economic indicators to determine what the best leading indicators for the liquidity cycle were on a multi-year time horizon. Because again, all the other indicators we just highlighted have explanatory power on a 3 to 6 month forward time horizon. But where might we be in liquidity, I don't know, 12 to 18 months from now? That's the kind of duration that our friend Rao tends to focus on. And I assume that's how he arrived at this conclusion. And so we arrived at a similar conclusion with our own math, which we found that the total non-financial sector debt, remember we talked about the refinancing air pockets earlier, this time series, the year-over-year rate of change of that on a 4.5 year lag has the best fit across hundreds of US and global time series, economic time series in terms of explaining the liquidity cycle. Now, it's not a perfect correlation. It's not a perfect one-to-one correlation. There are times where you see liquidity's down and the lagged observations of world debt growth are very high, and that's typically when you have negative outcomes in markets. So this is those back-to-back 15% declines in 2015. You see liquidity really low throughout 2022, despite the big rise in the global non-financial sector debt, 4.5 years prior. And so this is what we call a liquidity air pocket. Whenever you have a liquidity air pocket, bad things tend to happen in asset markets. But generally speaking, and that happened obviously in the GFC as well, you had declining liquidity despite a very high level of lagged debt growth. And so what that means is 4.5 years ago, if the red line is high, there was a lot of debt issued that needs to be refinanced. There's obviously, if you look at the modified duration of the global fixed income ag, it's somewhere around 5.5 years. And so that 4.5 year refinancing cycle tells you that about a year out, firms and governments start to refinance their debt, starting a year out before it's due. And so if the red line's high in this chart, that tells you that there was a lot of debt issued globally on a total non-financial sector basis years prior. And if the red line is low in this chart, it tells you that the growth rate of debt slowed dramatically and is actually declining on a relative to the trend. And so what we know is that there is going to be a significant acceleration in the lagged debt growth time series over the next, let's call it 18 months or so. And so the outcome for asset markets depends heavily on whether the blue line rises to meet that, to avoid a liquidity financing air pocket. If the blue line falls and you have a gigantic refinancing cycle ahead of us, stemming from 2020, all the financing that we did in the public and private sector in 2020 and 2021. Now that needs to be refinanced starting next year and into 2026. Well, if we saw liquidity decline or stay flat, we're going to have problems in asset markets because you're not going to see liquidity rise enough to actually allow those refinancings to take place. But if we did, and if the correlation holds, the general correlation holds, then it's likely that we will see liquidity accelerate, perhaps markedly from here. Now, I don't want to say that. I don't want to say that as a forecast because, again, I don't think you can. I don't think it's safe as someone who's built econometric models for buy-side firms all around the global world, all around the world for many years now. I don't think this is a safe enough investment, safe enough model to base your entire investment thesis and ultimately your entire portfolio on. But I do think it's a good enough model to understand what to look for to make sure that we are checking, hitting the right checkpoints and mile markets along the way so that we can understand, okay, we're watching the right stuff and the right stuff is evolving the way we expect it to. And the second we see that it's evolving the way we don't expect it to, we are faster to change our direction of our portfolio or change the positions in our portfolio to stay on the right side of market risk faster than other investors. Because again, you want to get out before the other folks figure out liquidity. There's a liquidity in your pocket and start to try to get out. And so this is one of those analyses that can help us anticipate that. But for now, the analysis is suggesting that we could see a significant increase in global liquidity over a long-term time horizon. We're talking 12 to 18 to 24 months, which is what the analysis suggests. So I did want to spend some time on that very important subject. I want to make sure investors are well aware of the variables that they should be using to forecast the global liquidity cycle, both on a kind of short to medium term time horizon, but also on a much longer term time horizon. And then finally, we actually do that math for our clients here at 42 Macro in terms of helping them identify, okay, where is liquidity likely headed on a short to medium term time horizon. So the key indicators of global liquidity, the ones that we highlighted earlier prior to the debt growth discussion, those key indicators imply a slight decrease in liquidity over the medium term, over the next, let's call it 3 to 6 months. And how we derive that conclusion is we calculate the correlation adjusted Z-score of those indicators, and then we take the sum of that correlation adjusted Z-score weighted by the correlations, and then we subtract the liquidity year-over-year Z-score from that sum. And if the value is negative, we're anticipating a decline in liquidity to catch down to how the current principal components are suggesting where liquidity should be. And if there's an excess, a positive sum excess, then we say liquidity is probably going to rise to catch up to how these variables have evolved thus far on a trend basis. And so in terms of how we kind of derive that nomenclature in terms of the qualitative assessment, if the sum minus the global liquidity proxy Z-score is kind of in the area code of 0 to 0.5 on a Z-score basis, we'll say there's a slight increase or decrease. And if the sum minus the global liquidity proxy year-over-year Z-score is positive, 0.5, or absolute value is 0.5 to 1, then we'll say there's a significant increase or decrease over the medium term. So right now, as you can see, the sum minus the year-over-year Z-score for the global liquidity proxy is a minus 0.1. So we're saying there's an ever so slight decrease in global liquidity likely over the medium term based on the current levels of the Z-scores of the leading indicators of global liquidity. Now that may change, and that's our job. And again, we refresh this model 6 days a week for our clients at 42 Macro so that we can call out, hey, when something is inflecting at some point, if slide 46, the chart on the right on slide 46 is going to be right in terms of projecting a significant acceleration in global liquidity over the, let's call it 12 to 18 to 24 month time horizon, then at some point, this model is going to start to do this. You're going to see the sum minus the year-over-year Z-score of the global liquidity proxy. Not the year-over-year Z-score, the Z-score of the year-over-year rate of change of the global liquidity proxy is going to go to slight increase, to even more slight increase, to significant increase, and if we're on the right track. And if we're not on the right track, then guess what? We'll call that out in real time to clients to tell them to not bet on a very Pollyannish expectation with respect to global liquidity. So again, it's when you're talking about forecasting, generally speaking, you always want to understand what the base rate is, what the starting point is, and then you want to use information Bayes factor in terms of the Bayesian inference. You want to use information to move your forecast away from the base rate, either to the up, to the down, or back around. So we'll keep moving there. So U.S. liquidity is important to track as well, and the 42 Macro net liquidity model is the gold standard across global Wall Street. I've created a lot of stuff that became very popular across global Wall Street. As you know, I cut my teeth across global institutional finance in terms of helping investors stay abreast of macro risks and building econometric models for different buy-side investors. And so one of the tools that we've built to help clients stay on the right side of U.S. liquidity cycles has become the way in which everyone monitors U.S. liquidity, and that's the Fed balance sheet minus Treasury general account balance minus the reverse repo facility balance metric. And so for those who may be not familiar, the Treasury general account balance is the U.S. Treasury, the fiscal authority's checking account at the Fed. If that number rises, it means they are taking money out of the economy in financial markets and putting it and parking it on the Fed's balance sheet. If that number falls, that means they are taking money, they're spending down the money they already collected from the private sector back into the economy, which ultimately winds up in the form of liquidity and ultimately back into asset markets. The Fed's reverse repo facility balance is a tool that the Fed built to soak up excess liquidity from the financial system. And so rather than allow T-bill yields to decline significantly lower than their policy rate because there's excess liquidity looking for a home, the Fed created this facility to essentially put a floor under the Fed funds rate. I want to say it's about the overnight rate you get from parking your money at the Fed in terms of this reverse repo facility. It's about 10 basis points lower than the Fed funds rate. So it keeps a kind of a floor under that Fed funds rate. And so what it does is if the RRP balance is rising, it means investors are taking money out of other financial markets and parking it on the Fed's balance sheet. And if the number falls, if the RRP decline metric falls, it means investors are taking money from the Fed's balance sheet and pushing it into other asset markets or maybe into the real economy, either or, depending on the substitution that you're seeing across money market, fund exposure, and overall sort of economic activity. And so the chart on the panel on the top just shows the net liquidity model on a time series basis. So again, that's Fed balance sheet minus the TGA and RRP values. That number had been declining throughout 2022, and then it started kind of meandering higher in throughout 2023, and really since the last kind of 4 or 5 months, it's been meandering lower. But if you kind of just take a step back and look at it on a multi-year basis, it's more or less stable, and this is consistent with some of the policies that we'll talk about from the Treasury in terms of helping stabilize the decline in net liquidity, which tends to be positively correlated to bank reserves. In this chart here, we just show each of those variables on an independent basis. So the Fed balance sheet, as we know, is right around $7 trillion. Current value of the Treasury general account is about $800 billion, and the current value of the reverse repo facility is at about $324 billion. And then finally, actually, not finally, what the red dotted lines in this chart indicate are spikes in the Treasury general account balance prior to tax day. So as you know, the Treasury collects taxes from the private sector to pay the government's bills. And so obviously in April 15th, there tends to be a pretty significant jump or leading into April 15th here in the US, there tends to be a significant jump in the Treasury general account balance. That jump tends to cause consternation in asset markets, generally speaking, but usually that consternation is short-lived because the TGA starts to decline from there as the Treasury has gotten better in recent cycles of anticipating these types of dynamics, and they use that in terms of changing their bill issuance, et cetera. But we'll talk about that in a few slides. Secondarily, penultimately, the purple dotted lines in this chart just show how the Treasury Secretary Janet Yellen has decided to proactively prepare for the debt ceiling in the last 2 cycles. In 2021, leading to the debt ceiling that the breach that we observed in mid-2021, she raised the TGA balance by $255 billion in the weeks ahead of that. And then looking into the debt ceiling debacle that we had in early 2023, she raised the Treasury general account balance by roughly $270 billion. So there is some seasonality in this time series, but there are also critical macroeconomic events that we must stay abreast of to accurately kind of project or at least anticipate how net liquidity, the blue line at the top, is going to evolve over the medium term. And then finally, at the bottom panel, we show the 12-month T-bill yield minus the RRP rate. And what we found is that typically when the 12-month bill yield is rising significantly, it's been really high, you typically means that the investor expectations for the forward policy rate are really high. So what ultimately means is that investors in the fixed income market are getting short duration. That means they're selling long duration securities like Treasury bonds, and they're buying short duration securities like T-bills and short-term Treasury notes and short-term commercial paper and short-term corporate credit to reduce the risk of those future expected policy rate hikes onto their portfolio. And then vice versa, what tends to happen is when the T-bill yield declines significantly relative to the observed policy rate, it tells you that investors are anticipating rate cuts. And so you tend to see the opposite dynamic with respect to the reverse repo facility balance is investors start to go chase positive performance in the long duration assets that they previously sold in the prior run up. So those are all important dynamics to monitor in terms of understanding U.S. liquidity, which is, in my opinion, not as important as global liquidity, but it is important and something that investors need to understand if they want to have superior investment results. So I mentioned earlier that U.S. liquidity is important to monitor. So there's a few dynamics within the context of U.S. liquidity that are important to helping investors kind of understand the projections and kind of anticipate the trends in net liquidity. So we'll start by understanding net financing and cash balance estimates via the quarterly refunding announcements. So what I'm showing in this chart, and the blue bars are privately held net marketable borrowing, and the red bars are the Treasury General Account target balance. And so this is the most recent quarterly refunding document. We got that number in late June. We get those at the second month of the quarter, the end of the first month of the quarter is when we get the quarterly refunding announcements that update the Treasury's projections on the current quarter and then provide projections for the subsequent quarter after that. So it's a lot of important information. We'll show you what the most important information within those Treasury General Account, the Treasury quarterly refunding documents. We'll give you a rundown on what you should be focused on when you're, observing the QRA and how to interpret the QRA from the perspective of asset markets. So we'll start with privately held net marketable borrowing. That's kind of the most obvious headline thing. Is in Q3 they're projecting to borrow $740 billion. That's a negative revision, so that's positive for asset markets relative from the April 2024 quarterly refunding announcement. Again, this is the July 2024 quarterly refunding announcement. In Q4, they're projected to borrow a net $565 billion. That's a $175 billion delta from the prior quarter. So that's also positive at the margins. That means the amount of net borrowing, not gross borrowing, net borrowing the U.S. Treasury is doing, sort of pushing onto the private sector, that number is declining by $175 billion in Q4. So that's generally positive. We'll talk about why sometimes it may not be. But if we go to the Treasury General Account balance, the end of Q3 Treasury General Account balance estimate is currently $850 billion. That would be a plus $50 billion increase from the current level of $800 billion. And so that obviously would be slightly negative from the perspective of that net liquidity model there at the top. They're projected to have that decline to $700 billion in Q4, which would be a projected $150 billion decline from the projected into Q3 numbers. So that's obviously positive. That means we could go up to 850 and then back down to 700. So that on a net basis, that would be a net positive outcome from the perspective of asset markets through the lens of this one feature, of which, as you can tell by now, there's a lot of stuff you need to know and or pay to know if you want to use macro to improve your investment results. A positive fiscal impulse typically leads to more net financing. So the budget deficit is growing. The Treasury needs to borrow more on a net basis, and a negative fiscal impulse typically leads to less net financing. So in this chart, we show the 42 macro fiscal policy monitor. So these are, we show the change, so various dynamics going on with respect to federal revenue, federal expenditures, and ultimately different dynamics with respect to the federal budget balance. This shows the nominal year-to-date calendar sum of each of those line items. This shows the share of total by category for each of those line items. This collection of columns shows the year-over-year nominal change. This shows the year-over-year percentage change. And then finally, the trailing 10-year Z-score of that year-over-year percentage change to give us a sense of, okay, is this growing fast or slow relative to how it's grown, over time. And so the thing I call out with respect to the quarterly refunding currently, the biggest thing I call out is the fact that we have a negative fiscal impulse. And so what this is showing is that on a calendar year-to-date basis, the budget balance is $1 trillion, or roughly $1 trillion $7 to be exact, or sorry, $1 trillion $7 million to be exact. On a calendar year-to-date basis through the same month through July of 2023, the budget deficit was minus, or was it 1.1 to $1.2 trillion, $1 trillion 192 billion to be specifically exact. So if you kind of did the math on that, the budget balance is up $185 billion on a calendar year-to-date, year-over-year basis. Budget balance up means deficit down. The deficit is getting smaller. That's very different than what we experienced as investors in the economy last year. Is the budget deficit was $844 billion larger. That means the budget balance itself got smaller. It went down in unit terms, which means the budget deficit got larger in absolute terms by $844 billion and on a calendar year-to-date basis through July of 2023 relative to July calendar year to date, July of 2022. So we had a significant a fiscal expansion in 2023 on a calendar year-to-date basis, and a slight fiscal retrenchment on a calendar year-to-date basis here in 2022, and that's part of the reason we're seeing net marketable borrowing decline, get revised lower, and it's projected to decline in the subsequent quarter. So we talked a little bit about, I briefly alluded to, there's some dynamics in the quarterly refunding document that are more important than others. And so over the next few slides, we'll kind of walk you through what we think are the most important dynamics to monitor in the context of the quarterly refunding. And so this here on slide 51, we show the issuance composition. And so what the issuance is we look at net bill issuance relative to net coupon issuance. Generally speaking, bills are good. Bills require the least amount of pain from the perspective of asset markets in terms of creating room for the financing activity of the U.S. Fiscal Authority, which sits atop of the global capital structure. The most important market in the world is the U.S. Treasury market. If the U.S. government wants money, it will get money, and we might have to be forced to sell other assets to capitalize the government. The government is at the very top of the global capital structure, and so obviously we like it as market participants if they're issuing funding themselves in the bill market, which investors can then turn around and hypothecate in the repo market and use for leverage as collateral for leverage, and so that's great. But if they're financing themselves in the coupon market, the opposite is true. We investors have to create space, balance sheet capacity to actually absorb those numbers. So if we look at it with respect, we'll isolate Q4 because that's the tip of the spear in terms of the information that we currently possess from the Treasury Department. The amount of bills that are being projected to being issued in Q4 is only $90 billion. That's the lowest seasonality adjusted sum since the fourth quarter of 2022. And what we mean by seasonality adjusted is that you typically have bills decline by a significant degree in the second quarter to account for those Treasury General Account tax holiday dynamics, not tax holiday, but tax day dynamics that we highlighted earlier. So typically bills decline in the second quarter. So if you ignore the fact that bills typically decline in the second quarter and just sort of say, skip all those, what's the quarter in which we had the least amount of bills prior to this? What's fourth quarter of 2022? But on the flip side, we have only $475 billion of coupons expected to be issued on a net basis in Q4. That's the lowest sum since the first quarter of 2024. So quarterly bill supply. So we show the composition ratios in terms of what percentage of the net market borrowings done in the bill market, financed in the bill market versus financed in the coupon space, which are any Treasury securities that are 1 year in maturity or above. And we see that on as a share of the Q4 total, bills are only 16%, which is the lowest seasonality adjusted share since 4Q 2021, 8%. And so we haven't seen this small of a share of bills projected to be issued on a net basis since 4Q 2021. And again, these are 4Q 2024 numbers. We're currently in 3Q now, so be aware. These dynamics will have more market impact as we get into Q4 and we actually start to see the influence of Treasury auctions on broader financial conditions. If you look at it on a trailing 12-month basis, because this is also important to track, if you look at it, bill's share is only 11% bills on a trailing 12-month basis through Q4 2024. Now, what does that mean? The reason this is important is because bills mature in under 1 year. And so if the maximum duration of a Treasury bill is 12 months. And so if you look at it on a trailing 12-month basis, the bills that were issued 1 year and a day ago have already come matured, and the bills that are issued a day ago are becoming mature today, and so on and so forth. And when those bills mature, that's money for investors to take and either reinvest in the bill market, or they can take and invest in stocks. They can invest in bonds. They can go buy a house with it. They can go buy Starbucks with it. They can go buy something else with it, buy an Apple iPhone, et cetera. So the amount of bills that are maturing on a 12-month basis does have important implications in terms of perpetuating either positive or negative changes in financial conditions. And so as you can see here through Q4, that's the 11% is the lowest share since the fourth quarter of 2022. And on a delta adjusted basis, when you're just looking at the direction of travel, it's the lowest share since the third quarter of 2021. And then finally, bond supply. So when you're talking about coupon issuance, obviously issuing a 2-year note is less onerous from the perspective of the private sector's balance sheet capacity than issuing a 30-year bond, which has a lot more duration risk component to it. So what we want to do as investors is understand the amount of bond issuance that the Treasury is issuing as well. And if you isolate Q4, it's only $169 billion of bonds in Q4. That's the lowest sum since 4Q of 2023. So we're moving in the right direction in terms of the Treasury's influence on financial conditions in terms of issuing bonds on a net basis. So it's a very mixed. If we kind of summarize the quarterly refunding announcement, actually, let me finish this one slide here before we do that. The Treasury General Account projections, which we also get in the quarterly refunding announcement, they're projecting a $150 billion reduction in the Treasury General Account balance in Q4, which is the largest projected decline since 1Q 2023. If you look at the beginning cash balance of $850 billion and the projected beginning cash balance for Q4 and the projected ending cash balance for Q4 of $700 billion. So the light blue bars in this chart, when they go down, that's good from the perspective of U.S. liquidity. It means the Treasury General Account balance falling, and the light blue bars rising is bad, which means they're projecting the Treasury General Account balance to rise. And so investors need to be aware of that. We saw, part of the reason we saw a significant decline in COVID was Treasury General Account had to finance itself really quickly. And we obviously had to make asset sales, we, the global private sector, to account for, to create this balance sheet space to absorb all the net financing activity that we saw out of the Treasury Department back then. And obviously, once we did that, asset markets were off to the races, aided and abetted by some very aggressive monetary largesse as well. And so kind of summarizing this, with respect to forecasting the U.S. liquidity cycle, it's very important to understand how U.S. liquidity is calculated. As I mentioned, our model is the gold standard across global Wall Street. It's everybody's net liquidity model now, thanks to to one of our big clients. They know who they are, but we appreciate them anyway. So in order to understand the dynamics and kind of anticipate changes in the trends in U.S. liquidity, you need to understand how the U.S. government is financing itself and how what it's doing with the financing in terms of the composition, but also in terms of its end of quarter cash balance projections and how those are evolving, because all those are important dynamics to keep track of in terms of how the Treasury influences U.S. liquidity and ultimately how the Treasury influences broader financial conditions. Obviously, we've seen times where the Treasury's activities were really onerous from the perspective of the private sector. We saw a $255 billion increase in the TGA in the third quarter of 2023. We saw a significant jump in bond issuance in the third quarter of 2023. We saw, I want to say, I'm sure we did. We saw a decline in, coupons. Sorry, my apologies. Coupon issuance in Q3 2023. We saw a significant jump in coupon issuance in Q3 and Q4 of 2023. And all those things, if you go back to last summer and into the early fall, we saw a significant rise in nominal real interest rates. I want to say we got above 5% on the 10-year, and that obviously created a lot of financial market volatility across asset classes back then. So those types of dynamics is very important. You can practically prepare for those things by keeping track of some of these indicators, and obviously we keep track of all the stuff on a systematic basis for all of our clients here at 42 Macro. All right, so we talked about why macro matters in terms of perpetuating dispersion within and across asset markets. We talked about some of the key indicators to watch, specifically with growth and inflation and other key indicators and cycles to watch. We talked about helping you forecast global liquidity and then also forecast the U.S. liquidity. And these are all important dynamics to help you use macro properly and effectively to improve your investment results. Now we'll talk about forecasting the business cycle, which in our opinion is the combination of all those things: growth, inflation, policy, liquidity, credit cycle, market cycle. All those things kind of get pushed together in terms of formulating the business cycle. And it's important, really important as investors, to understand where you are at any given time in the business cycle. It's very important to know if you're here, in so much that it's equally important to know if you're there, because there's a lot of risk to the upside when you're here, and it tends to be a lot of risk to the downside typically once you kind of cross the lower bounds and they start to really get investors concerned about the growth cycle. But we'll talk about all that later. So without further delay, let's just hop into it. So you can accurately forecast the business cycle. I'll start by saying that some folks believe that you can, other folks believe that you can't. If you use big data, you can. If you kind of just stringing together chart A and chart B and podcast A and podcast B, I'm going to cut you in on a little dirty little secret. You're not going to be able to forecast a business cycle that way. It's way too dynamic. It's way too big. There are way too many very hard to predict cycles that formulate the broader business cycle. And so if you're not using the preponderance of evidence, the preponderance of data, proven quantitative techniques, you're probably going to struggle to identify exactly where you are in the business cycle and where you're likely headed, because that's usually where asset markets are headed. And so we did a big deep dive empirical study, the largest I've seen in terms of folks that do what we do for a living. I haven't seen everyone on the buy side, obviously, but in terms of what we do for a living, to identify the indicators that help investors proactively predict the business cycle. And so what this table identifies, I'll just kind of read left to right here. It identifies the indicator by name. It identifies whether or not the indicator is a leading indicator of the business cycle, which means it leads the other elements of the business cycle. If it's a coincident indicator of the business cycle, or if it's a lagging indicator of the business cycle, which means the broader business cycle is influencing it as opposed to it influencing the broader business cycle. And what we show, the dark blue leading determinations indicate that particular indicator is a persistent leading indicator, which means it leads to the business cycle, both to the downside and to the upside, which we'll talk about shortly. And then the latest value of the indicator currently, and then the latest trailing 10-year Z-score for that particular indicator to get a sense of whether it's above or below its respective trend. And then this is where the funds happen. So the color-coded table here on the right shows the median trailing 10-year delta adjusted Z-score in months from the start of recessions. And this is all the post-war business cycles stacked on top of each other for each of these indicators to identify how the indicator has performed leading into recession and then leading out of recession. And so that's a very important thing to note, to identify, okay, which indicators actually lead on the way down, and then ultimately which indicators lead on the way up. And so as you can see, there are a collection of persistent leading indicators of the business cycle. Obviously, the policy rate is one of them. Corporate profits are one of them. Our corporate profitability model, which we use to forecast margin expansion or contraction, that's a persistent leading indicator, means it leads the business cycle both to the downside and the upside. Real GDP growth is the leading indicator of the business cycle. Real goods PC, so goods, consumer spending on goods, is a persistent leading indicator. Real investment and fixed investment, so capital spending, is a persistent leading indicator of the business cycle. Residential fixed investment is a persistent leading indicator of the business cycle. The imports are a persistent leading indicator of the business cycle. The ISM manufacturing and services PMIs are persistent leading indicators of the business cycle. The goods sector employment, so the goods cycle broadly, both on the consumption side and the employment side, are persistent leading indicators of the business cycle. And then private sector average weekly hours and non-farm productivity growth are persistent leading indicators of the business cycle, of both business cycle downturns and upturns. So this is the same table, just showing the the table on the right here, the color-coded table on the right, just shows the median trailing 10-year delta adjusted Z-score in months from the start of recovery for all the post-war business cycles. So again, what we're doing here is we're taking each of these time series, and instead of analyzing it in linear time series format, we're stacking them on top of each other to identify what the path of those time series is on a median basis, in and around the business cycle. So we date the business cycle by the beginning of recession is a 0 here, so minus the months before recession and months after recession there. And then we date the business cycle, the beginning of a recovery, an economic expansion here, months before the beginning of the expansion, months before the end of the expansion, or post the beginning of the expansion there. And so it's a very important table. It's a very important analysis to help investors understand, what the heck should I be looking at? As we're bombarded with charts all day long, we're bombarded with people talking about charts all day long, but sometimes some charts are more important than the others in terms of keeping you on the right side of market risk. If you're looking at something like credit, which we'll talk about later in this section, as a tool for trying to help you identify where the markets are headed, guess what? You're wrong. The market cycle leads the credit cycle. And if you don't know that, you're looking at the wrong stuff. And so it's very important at the bare minimum to use big data analysis like this to understand, what should I actually be, assigning my focus budget to. We are all human. We all have, some focus budget that's 100% pie. We don't have more than 100% of our focus to give away. And so if we're spending a significant chunk of our focus on stuff that doesn't matter in terms of predicting where markets are headed, then it's a waste of time. So what we're trying to do with this analysis is to get rid of that share and fill it in with stuff that's actually going to help you make and save money in asset markets. So let's get back into it. You can accurately forecast business cycle downturns and upturns with reliable high frequency indicators. So we talked about all the main indications of the business cycle across policy, profits, liquidity, growth, the markets themselves, the employment, labor market, credit, and ultimately inflation. And keep your ears glued to that order, because that's a very important order. If you learn, it's one of those more important things you're going to learn today is the order of operations for how the business cycle actually works. And so you can start allocating your focus budget appropriately and away from stuff that causes you to miss the turn. So getting back into these reliable high frequency indicators, we've identified. So these are all the main kind of monthly indicators that we receive as investors from the throughout the course of the month that the market has its attention glued to, and some our own that we derive from some of the main indicators. And what we try to do is help investors identify, okay, what are the most reliable monthly, weekly, or high frequency indicators that give us a good chance to identify swings and inflections in some of these more kind of slower moving indicators, like a GDP, for instance, those types of things, or a Fed funds rate, where we're trying to predict where that might be headed, et cetera. So in terms of identifying the persistent leading indicators on a monthly high frequency basis or weekly high frequency basis for some, it's as I mentioned earlier, the ISM Manufacturing and Services PMI. Those are persistent leading indicators, meaning that they lead to the they lead the business cycle both to the downside and to the upside. If it's just a regular leading indicator, it just means it only leads to the downturn or only leads in an upturn. But again, we're focusing on the dark blues here in terms of those indicators. Those are the ones we need to be focused on a consistent basis in our analysis. So within the labor market, it's initial jobless claims, continuing jobless claims, the University of Michigan Employment Survey, the Conference Board Labor Survey differential, and continuing claims to total labor force ratio. Those are the 42 macro Fab 5 recession and or recovery signaling indicators. So those are 4 or 5 of the most important data points you can get from the labor market in terms of anticipating where the labor market might be headed after you receive those data points. Cyclical unemployment, which is the total amount of folks who are in the unemployment pool that have just been fired or completed temporary jobs. That is a persistent leading indicator of the business cycle, as is temporary employment. Good sector employment, so the manufacturing employment is a persistent leading indicator. The private sector average weekly hours is a persistent leading indicator as well. Turning our attention to the fiscal policy data that we get from the Treasury every month. Federal expenditures are a persistent leading indicator of the business cycle, meaning that they inflect their trend and flex before the broader business cycle inflects. So that's something we need to be monitoring. Headline retail sales, so consumer spending on goods and auto sales in particular, are both persistent leading indicators of the business cycle. Industrial production and capacity utilization are also persistent leading indicators of the business cycle. The NAHB housing market index, so home builder sentiment, is a persistent leading indicator of business cycle, as are housing starts and building permits. And then finally, real goods PCE, so consumer spending on goods on a broader basis, not just retail sales. The real disposable personal income and the real disposable personal income ex government transfers. So across all the different high frequency indicators that we get here in the U.S. economy on a monthly basis, those are the ones you should be paying most attention to. And I would argue you're probably wasting time if you're paying attention to anything else, because it's not a persistent leading indicator of the business cycle, meaning it's not going to give you a reliable signal and heading into a downturn or an upturn in the business cycle. And then obviously we identified the key leading indicators, persistent leading indicators in the previous 2 slides. So you can also proactively position for downturns and upturns in the market cycle by identifying assets that outperform late in economic expansions on the way down in markets, or identifying assets that outperform early in economic recoveries. And so what we find is that on the way down in asset markets, we want to be looking for things that lag. So things like consumers means that they break down slower or not slower. They break down slower than the other factors, meaning that they will give you a defensible portfolio for longer heading into a market downturn. And vice versa, heading into a market recovery, you want to identify the indicators that are leading and that outperform early in that process. That gives you a good chance to identify, to create a portfolio that will maximize upside capture and coming off the lows of a bear market. So on the way down, let's talk about some of those indications. Actually, no, we'll actually keep moving here. So actually, I'll show it to you on a time series format, so it's a little bit easier on the eyes. So how does the business cycle work? So we're going to ask that question over and over again in terms of the various cycles within the business cycle. Again, there's policy, there's profits, there's liquidity, there's growth, there's stocks, there's employment, there's credit, and there's inflation. These are all the independent cycles that we're not, sorry, independence is a strong word. They're not independent. They're codependent, and there's multi-collinearity associated with these time series. That's a big statistical word we don't have time to explain here, but they're not independent, but they are their own individual cycles that are influenced by the other cycles. That's a better way to say it. And so what these charts show is the data in these tables here. Are we showing it in time series format? And so it's a lot easier on the eyes to actually view. And so again, what this shows is the median trailing 10-year delta adjusted z-score for the particular indicator across all the business cycles stacked on top of each other since in the post-war U.S. economy. So I want to say there have been 12 or 13 business cycles in the post-war U.S. economy. So we're stacking all 12 or 13 of them on top of each other to identify what the median sort of progression of each time series is, or each time series is in and around recession, with 0 being the start of recession, or in and around recovery, with 0 being the start of recovery in the chart on the right. So you're going to see a lot of charts like this that look like this, and so just be aware that that's how you should be interpreting the analysis. And then finally, I'll say the table here, the key for each of those charts is organized. The actual order of the policy, the order of the operations shows how the business cycle actually works. So, for example, heading into a business cycle downturn, policy breaks down or on a delta adjusted basis. And what we mean by delta adjusted is we are orienting the time series in a way that that corresponds to if it's a business cycle downturn or business cycle upturn. So, for example, the policy rate itself going up is countercyclical to the business cycle. So we delta adjust it. So that means that it's getting worse for the broader business cycle, that the value goes down. So just be aware of that. It just makes the analysis easier on the eyes and there's a lot less clutter on the chart. So it doesn't mean anything statistically. It just means we're just making it easier for you to consume. So just be aware of that. So how the business cycle works in terms of the order of these indicators for the various cycles of the business cycle here in this chart is policy breaks down first. Then it causes corporate profits to break down. Then that causes liquidity to break down. Then it causes growth to break down. Then the market breaks down. Then employment breaks down. Then credit breaks down. Then inflation breaks down. So that's how the business cycle works. When you stack all the post-war U.S. business cycles on top of each other, which I would argue you shouldn't go back much further than that because the nature of the economy is significantly evolved since then. So you do want to be using good data when you're using big data. That's one of the challenges of big data, but generally speaking, but that's very important to know. So as I mentioned earlier, if you're focusing on rising credit card delinquencies to predict where the stock market is, guess what? It's useless information because the market cycle leads the credit cycle. If you're trying to figure out, if you're saying, oh, inflation's low, therefore growth's going to slow, guess what? That's not how the business cycle works. Growth leads inflation by a considerable degree. In fact, if you look at the month in which growth breaks down below trend, typically ahead of a recession, it's right around kind of 2 quarters ahead of a recession when growth sustainably breaks down below trend. Inflation doesn't durably break down below trend until about 12 to 15 months after a recession has already started. And so investors need to be aware that inflation is the most lagging indicator of the business cycle, both in business cycle downturns, but also in business cycle upturns. And the final thing I'll say about this slide is that the business cycle downturns are not necessarily identical to business cycle upturns because guess what? We have the influence of policy that tends to want to chop off the left tail of the distribution in economic outcomes for obvious reasons, because politicians like to create good outcomes so they get reelected. And so the order of operations can change and does change across a variety of these cycles when you're talking about a business cycle upturn. So when we're looking at a business cycle upturn, the things to monitor for a business cycle upturn first are liquidity gets better first, then policy eases, then the market recovers, then corporate profits start to recover, and growth broadly recovers, then unemployment recovers, then credit recovers, then finally inflation recovers. So notice that the order of operations in a recovery in a business cycle upturn is not the same order of operations in a business cycle downturn. Those are not the same thing. So investors need to be aware that the business cycle is a collection of cycles that helps investors identify exactly where they are in terms of growth, inflation, policy, employment, all these major things that we are talking about regularly. And if you understand how they have historically evolved and what leads what, then you can practically predict the business cycle in a way that helps you make and save money in asset markets. So let's talk about the current business cycle. We're in a upturn with a likely downturn ahead. So this is just the trends of the current trends of each of these data. I want to say it's a trailing 2-year chart here, showing each of these data on a delta adjusted z-score basis. And so instead of trailing 10-year, so what we show here in these charts, we show just a z-score relative to the 2015 to 2019 trend to give ourselves a general sense of how the economy has performed in this kind of weird post-COVID economy, which I think we can all agree has been a lot weirder than most business cycles that most of us have risk managed throughout our careers. And so it gives us a sense of how deviant we are from that particular kind of quote unquote normal level of activity. And so right now we're in a business cycle upturn. Most of these indicators are generally trending higher, starting to crest a little bit, but they're all above trend. But the thing that leads the business cycle continues to be significantly below a trend when you look at it on a delta adjusted basis, which means the policy rate is really high. But in terms of its influence on the business cycle, it's telling the other things here that it leads. It's the most leading. It's telling these things to come catch down to it. And eventually, we're going to see growth, profits, liquidity, growth, markets, deployment, all this stuff catch down to it, unless the Fed can quickly get the policy rate to a more sanguine setting. But it seems unlikely, at least based on current market pricing. So how does the policy cycle work? So the next sequence of charts, we're going to unpack each of these cycles in the context of the business cycle. As I mentioned, remember, policy leads profits, then profits lead liquidity, then liquidity leads growth in stocks, then employment, then credit, then inflation. Said differently, policy breaks down first, then profits break down, then liquidity breaks down, then growth breaks down, then stocks break down, then employment breaks down, then credit breaks down, then inflation breaks down. So we're focusing on the potential for a business cycle downturn, because obviously we're late in the business cycle, as evidenced by the inverted 3-month 10-year Treasury yield curve, the level of unemployment, the level of jobless claims, and the level of other indicators that are pretty clear and consistent with a late cycle economy. So it's important for us to identify, okay, obviously we're late cycle, but are we now starting to slow? What's the rate of change of that slowdown? And is the rate of change of that slowdown more or less than what consensus expect? And if it's less than what consensus expect, then you can have positive results in asset markets. If it's more or than what consensus expect, you're probably going to have negative results in asset markets. And so that's how we're using this type of analysis to identify exactly where we are and where we likely headed in the business cycle. So as I mentioned earlier, we're in a business cycle upturn with a likely downturn ahead based on the leading indicators of the business cycle. So let's unpack each of these cycles independently going forward. So the policy cycle, how does that work? So the policy rate tightens, then federal tax receipts break down, then federal expenditures break out, and then the federal budget deficit breaks out. That's how the business cycle works in and around recession on the way in the business cycle downturn. In a business cycle recovery, first policy eases, then the federal budget deficit breaks down, then federal expenditures break down, then federal tax receipts break out. That's typically how the business cycle works with respect to policy. And the current policy cycle suggests that we have tight monetary policy with neutral fiscal policy. So we don't have a significant deviation in fiscal policy or monetary policy. We did have significant deviations in fiscal policy going back to 2022 and 2023. In 2022, we had a significant drawdown in the growth rate of federal expenditures and a drawdown in the overall budget deficit. This was the largest nominal fiscal contraction in the history of the U.S. economy that we observed in 2022. And then we had the exact opposite happen. We had a significant increase in the growth rate of federal expenditures and the federal budget deficit. And so now we're back to a more normal level of change with respect to the budget deficit. So again, we have tight monetary policy with neutral fiscal policy currency. How does the profit cycle work in terms of the key leading indicators of the profit cycle? So heading into a business cycle downturn, with zero being the starting line. Corporate profits break down, then our corporate profitability model. And what we mean by corporate profits, these are NIPA corporate profits on a year-over-year basis. Whenever you see that here, and so whenever we say corporate profits, that's what we're talking about, NIPA corporate profits. Then our corporate profitability model breaks down, then economic growth breaks down, GDP growth, then household net worth breaks down, then S&P 500 earnings break down, then S&P 500 earnings expectations break down, then gross domestic income breaks down, then corporate net worth breaks down. So that's how the business cycle works within the context of the profit cycle in a business cycle downturn. In a business cycle upturn, we have our corporate profitability model and corporate profits breakout simultaneously. Then you have household net worth breakout. Then the S&P 500 next 12-month earnings expectations breakout. Then gross domestic income breaks out. Then growth breaks out. Then trailing 12-month earnings breakout. Then corporate net worth breaks out. So if you're looking at things like corporate net worth to predict economic outcomes or financial market outcomes, look, let me stop you right there and tell you to go find a better indicator or use these indicators, because what we're trying to do is high grade the units of time that you're spending, using things like macro or even micro to improve your investment performance. If you're looking at the wrong stuff, you're probably going to have bad results. If you're looking at the right stuff, you're going to spend less time looking at it, and you're probably going to have better results. And that's exactly what we're trying to get you to do here in this presentation. Looking at the current profit cycle, we're in an accelerating upturn. So we have positive trends in the both on a delta basis, but also on a levels basis as well. So that we are above trend and across all these most of these metrics, particularly the metrics that lead the corporate profit cycle, and they are actually they're improving sequentially. So that's very positive, particularly in the context of corporate profit cycle being the second most leading cycle within the broader business cycle. An accelerating upturn suggests that things are relatively fine. They're obviously going to eventually get worse, but you need to understand that we probably need to see this get worse before things get broadly bad in absolute terms. How does the liquidity cycle work? So that's the third cycle in terms of the progression of the business cycle in a downturn. So the key leading indicators for the liquidity cycle is the US dollar, then liquidity breaks down, then stocks, then household net worth breaks down, then bonds break out, then corporate net worth breaks down, then commodities break down, then gold breaks down. That's kind of how the liquidity cycle works in terms of a business cycle downturn. And then it's a little bit different on the business cycle upturns. First, liquidity breaks out, then stocks break out, then bonds break down, then commodities break out, then household net worth breaks out, corporate net worth breaks out, followed by the dollar and gold, which have somewhat inconsistent patterns there. Not every cycle in each of these charts has a consistent pattern, and we'll call that out. But generally speaking, all of these cycles within the charts are either something that leads, or a very important cycle that leads or lags the other cycles, or something that we care about as investors, like the dollar and gold, that may just be kind of noise in the context of that. And so in this particular analysis and the business cycle, liquidity cycle upturn, dollar and gold don't have consistent patterns of behavior. The current liquidity cycle, we're in a moderating upturn. So we are above trend in terms of the key indicators to watch, particularly in terms of their delta adjusted Z-score, again, relative to the 2015 to 2019 trends. We're above trend in those things, and in terms of leading indicators, but they're actually starting to get a little bit worse. So they're moderating. So we've been in an upturn, but it's getting worse. It's moderating. We're starting to slow from a high level. That's what a moderating upturn is. Accelerating upturn is you're getting better or rising from an already high level. A moderating upturn means you're falling from an already high level. A moderating downturn means you're rising from a low level. And a accelerating downturn means you're falling from an already low level, which means that's kind of the worst situation you can be in from the perspective of things like corporate profits, liquidity, growth, et cetera. How does the growth cycle work? So looking at key leading indicators of the growth cycle. So on the way down, consumption leads, then investment, then GDP growth broadly, then government expenditures, then net exports doesn't really have a consistent pattern of behavior. So we can kind of X that out the analysis, but we keep it in there just so we can communicate that to investors. I personally analyze every high frequency variable that comes out of all the 10 major economies in the world that we feature in our global liquidity model every single day in rate of change format. That's something we promise to our clients so that we can help them understand exactly how those things are evolving in a way that influences the liquidity cycle or the broader market cycle. And I tell you right now, I spend 0% of my time on a daily, weekly, or monthly basis talking about exports, because I know that exports don't matter. They're not going to be leading, or imports or exports. They're not leading indicators. They're just not. So what we're trying to do is high grade the units of time that we spend analyzing the macroeconomy so that we can create crystal clear, actionable signals in less time than it takes other investors, so that we can reposition our portfolios and get in line ahead of them, so that when they make transactions, we actually benefit from the transactions they're making, as opposed to paying them for the transactions that they made. Getting into a recovery. So how recovery works is not the same as the way it is on the way down. First, business investment inflects higher, then growth, then consumption, then government, and then inconsistent signal with exports. So where are we in the growth cycle? We're in an upturn currently with a likely downturn ahead. So as you can see, you have the delta adjusted Z-scores for the various cycles within the growth cycle are positive. And so that tells you that, we're kind of, up on the hill, but the leading indicator, the one that leads in the way down, is on below, it's already lower. And so these 9 other ones should catch down to where the consumption cycle is at a bare minimum, and if the consumption cycle starts to slow down so incrementally, then that'll be cause for alarm in terms of the speed and the level, the distance that we have to travel for the other cycles within growth to catch down to it. So be aware of that. But yes, we're currently in an upturn with a likely downturn ahead based on the leading indicator of the growth cycle in a business cycle downturn, because again, it's not always the exact same. Getting into the market cycle. So again, the market cycle follows the growth cycle. The growth cycle tends to break down before the market cycle does in a business cycle downturn. And so how the market cycle typically works in a business cycle downturn, we'll start with equity sectors and then we'll quickly pivot to equity factors, is the consumer discretionary breaks down, then comm services break down, then real estate breaks down, then financials break down, then tech breaks down, then the broader index breaks down, and then industrials break down, then healthcare breaks down, then consumer staples break down, then utilities break down, then energy breaks down, then materials break down. So this is the historical pattern of how S&P 500 sectors have historically evolved heading into business cycle downturns. And so obviously heading into business cycle downturns, you want to be long the cycle, the elements of the market that break down last, that tend to break down last. And so those are things like healthcare, consumer staples, utilities. Those are traditional defensives. But I don't think a lot of investors are aware that there's a lot of back-tested market history of energy and material stocks tending to outperform late in the business cycle, because guess what? As we talked about earlier, inflation is the most lagging indicator of the business cycle. So obviously, as inflation breaks down latest, then you typically have energy and materials, commodity producers breaking down latest as well. And then in a business cycle upturn, in a recovery, you have stocks break out, the broader index breaks out before everything else. So if you're trying to look at this and predict the stock market, guess what? You're not going to do it. Then materials break out, then consumer discretionary break out, then consumer staples break out, then real estate breaks out, then tech breaks out, then healthcare breaks out, then financials, then industrials, then comm services, then energy, then utilities. Now, again, I don't want to sit here and say that every business cycle was the same. These are the median trailing 10-year delta adjusted Z-scores for the 12 or 13 business cycles that we've experienced as investors in the post-war era. Now, again, you can't take this and say, okay, well, Darius Dell told me that materials are the last sector to break down or consumer discretionary is the first sector to break out. What we're trying to do is show the general trend of how the economy and asset markets have performed so that we understand what the base rate actually is, so that we have more accurate forecasts of how the economy and markets are likely to perform. If you don't know what the base rate is, then how can you possibly have an accurate forecast? I mean, it's like throwing spaghetti on the wall. It's a lot easier to paint when you have it's a lot easier to fill in a coloring book than it is to paint by throwing spaghetti on the wall. And if you don't know what the base rate is, then you're painting by throwing spaghetti on the wall. You might make a Picasso, but more than likely, you're just going to have a messy wall with spaghetti dripping down it. So let's keep it moving. The current in the market cycle. So these are just the equity sectors. There's really no information to glean here. We're just showing you how they're currently performing right now. As you can see, comm services is by far and away leading to the upside as in the current market cycle. So how the market cycle works from an equity factor standpoint. So sectors are obviously, the types of companies that make and sell certain types of goods. The factors of the equity markets have more to do with the performance of the business or the performance of the stocks themselves, and they're grouped into different quantiles and buckets that allow investors to ignore what the company actually does for a living and actually group them based on specific characteristics that correspond to levels and units of risk that investors might want to take. And so when we think about how the business cycle downturns work from the perspective of the market cycle, from an equity factor perspective, first stocks break down, then low beta breaks down, which a lot of investors will be like, oh, I didn't know that. Momentum breaks down. Low beta, by the way, these are stocks that tend to have the worst margins, by the way. They have the lowest margins. They have the least cyclical margins, but they tend to have the lowest margins. So if you lose growth, you tend to have big squeezes in those companies. And Home Depot told you that yesterday. Global equities break down, followed by high beta, followed by value, followed by defensives, followed by cyclicals, followed by quality, followed by growth, followed by commodity producers. So if you want to be defensive in your portfolio from the perspective of the equity factors late in the business cycle, the kinds of exposures you want to have in your portfolio are things like, you can barbell, I hate this too overused of word, but defensive, which means stocks have a lower amount of volatility in their earnings and cash flows, cyclicals like commodity producers, and quality and growth. Those are the types of factors that tend to outperform late in the business cycle because investors are looking for growth. All these other factors and sectors have already lost the growth. And so there's no reason to be long those things. So you're looking for things that are either maintaining growth or still showing accelerating growth. And that's typically what happens late in the business cycle, which are quality growth companies and commodity producers, which are benefiting from inflation, which again is the most lagging indicator of the business cycle. And we'll have some very important conclusions on that later. So this is how the equity factors tend to work in the recovery. Stocks break out, then growth breaks out, then cyclicals break out, then quality breaks out, then commodity producers break out. So it looks very similar to how it does on the way down, on the way out. So the stuff that breaks down last starts to actually outperform earlier because investors are, again, they're more convinced that there is legitimate growth in these companies than there are in the other companies, followed by defensive value, momentum, low beta, global equities, and high beta. So again, we show the equity factors here. Momentum by far the dominant factor, low beta by far the worst performing factor currently. So how does the employment cycle work? So shifting ahead back into the broader business cycle, the key leading indicators of the employment cycle in terms of how that works. First, non-farm productivity breaks down, then private sector hours work breaks down, then GDP growth breaks down, then total employment breaks down, then nominal employee compensation breaks down, then private sector wages break down, then unit labor costs break down. And you can see non-farm productivity is and private sector hours work are very long-term leading indicators. They break down 3 to 4 quarters ahead of a business cycle downturn. And so investors need to be aware of that. And then with respect to a business cycle upturn, non-farm productivity breaks out, then private sector hours work break out. So we mentioned earlier, they're persistent leading indicators because they lead in both downturns and upturns. Then growth breaks out, then employment breaks out, then nominal employee compensation breaks out, then unit labor costs and private sector wages kind of flip there. But so it's a pretty consistent pattern in terms of how the labor market works, both to the downside and to the upside in terms of the labor cycle, the employment cycle rather. And so if you look at the current employment cycle, it's actually quite mixed. It's not at an obvious upturn and it's not at an obvious downturn. And so if you look at the delta adjusted Z-score for these variables, we have the most leading indicator, non-farm productivity. It's very clearly in an upturn and quite robust one as well. But then you have the second most leading indicator, private sector hours work. It's in a downturn, moderating downturn. It's actually getting better, but it's still technically in a downturn in terms of the negative delta adjusted Z-score in terms of where it is in its prospective cycle. So this kind of makes no real obvious conclusion, and that's kind of consistent with where we've been in the labor market. I've been doing this for 15 going on 16 years in terms of flying around global Wall Street all across the world, meeting with institutional investors and obviously coaching thousands of retail investors in terms of how to use macro to improve their investment results. And the reality is, I don't think I've ever seen so much dispersion amongst investor assessments of the U.S. labor market. Generally speaking, we all kind of agree on the conditions in the labor market. But this is in this particular cycle, this has been one of the most unusual cycles that I've seen. But fortuitously, we've been on the right side of it in terms of anticipating the resiliency of the U.S. economy. In fact, check the record. We were the ones, we, 42 Macro, were the ones who authored the resilient U.S. economy theme going all the way back to the summer of 2022. We've consistently pounded the table on the resiliency of the U.S. economy. If you go back and you look at the long leading indicator, the longest leading indicator of the employment cycle started to moderate. It was a downturn, but it was a moderating downturn back then, and obviously swung into a very obvious accelerating upturn dating back to the middle of last year. So, and that's obviously been consistent since then. And so if you want to get the employment cycle right, you want to get any of these cycles right, particularly the broader business cycle, which is the collection of all the most important cycles that we care about as investors and need to get right to have superior investment performance, you need to pay attention to the persistent leading indicators. Don't just pay attention to everything. Don't just pay attention to everyone. Pay attention to the things that matter most, and pay attention to the investors that can give you a consistent, generate consistent signal from their analysis of the things that matter most. So getting back to the broader business cycle, how does the credit cycle work? These are the key leading indicators of the credit cycle. So first, residential real estate credit breaks down in delinquency terms. Again, these are all delta adjusted. So obviously delinquencies going up is bad. Delinquency going down is good, but they're all delta adjusted to make the chart make sense in the context of just reviewing it as an investor in the business cycle context. And so first what happens is residential real estate credit, those delinquencies break out, i.e. they break down in terms of what they mean for the broader business cycle. Then growth breaks down, then commercial real estate credit breaks down, then real estate credit breaks down, then credit card credit breaks down, then consumer credit breaks down, then broader credit breaks down, then personal loans credit breaks down, then C&I commercial and industrial loans break down. And I mean, look how long it takes for C&I loans to go sour. It's usually right around 3 quarters after recession starts versus residential real estate about 3 quarters before recession starts. Those delinquencies start to deteriorate in a material and observable manner. And then with respect to a recovery in the credit cycle, First, growth breaks out, before each of these variables breaks out. So growth leads to credit cycle. Credit card delinquencies, kind of start to improve. And consumer credit delinquencies improve. Then personal loan delinquencies improve. Then residential real estate credit improves. Then broader credit improves. Then commercial and C&I lending improves. Residential real estate credit improves, and then commercial real estate credit improves. And so, as you can see, it's not a consistent pattern on the way down and on the way up. So investors need to be aware of that. It's important to know that these things are not persistent. Not every indicator you're paying attention to is a persistent leading indicator. It's very important to know that, so that if you're at the bottom of a business cycle, you focus your attention on the things that are going to lead to the upside. However, if you're at the top of a business cycle, you focus your things that are pay attention to the things that are going to lead to the downside. If you're just paying attention to everything all the time, or the wrong things all the time, you're going to have worse results than investors that are paying attention to the right things, or paying someone to pay attention to those things for them. So getting into the current credit cycle, it's mixed. It's not an obvious upturn or downturn. If you look at the kind of long leading indicators of the credit cycle that are endemic to the credit cycle, so skipping growth and commercial real estate credit, residential real estate credit's fine. At best, it's a sideways upturn. And then if you look at commercial real estate credit, that's in an accelerating downturn. And so it's a mix. It's not an obvious upturn or downturn in terms of where the chart might look like, on a 3 to 6 to 12 month forward basis. And so investors must be aware of that. How does the inflation cycle work? If you look at the key leading indicators of inflation, and this is one of my favorite things to talk about right now, because we have some pretty divergent views on inflation, as we talked about with respect to our grid model. I don't think those divergent views are going to matter to asset markets. We're generally sanguine with respect to asset market performance over the medium term, but we do think by the time you get into the first half of 2025, and I'm sure by the time you're viewing this video, it might be the first half of 2025. We expect things might be a little bit different in terms of how investors are assessing, the two-sided inflation risk and what that ultimately means on the forward rate curve, and the potential bond market volatility we might see out of that could potentially spill over into broader asset markets. But again, that can be 2 trades from now. We're not worried about that today. We're worried about teaching investors how the inflation cycle works. So getting into the inflation cycle, all the different indications of the inflation cycle, looking at a business cycle downturn, first, core CPI breaks down kind of right alongside headline CPI, right alongside headline PPI. And then you have energy CPI breaks down, then food CPI breaks down, then shelter CPI breaks down, then core services CPI breaks down, then core goods CPI breaks down, and then super core CPI. There's not enough time series in that time series to actually perform the full analysis. So it's omitted from the chart. And so on the way up, it's a little bit different. First, energy CPI breaks out, then food CPI breaks out, then headline CPI breaks out, followed by core CPI breaking out, then shelter CPI breaking out, then core services CPI breaks out, then core goods CPI breaks out, then headline PPI breaks out, and then again, don't have enough time series history for the super core CPI time series. And so again, you need to understand these things. And probably the most important thing to understand with respect to the inflation cycle is the fact that it's by far the most lagging indicator of the business cycle. It breaks down 4 to 5 quarters on balance on a median basis in every post-cycle U.S. business cycle, dating back to in the post-war era, which I want to say again, there's 12 or 13 of those business cycles to analyze. On a median basis, it breaks down 4 to 5 quarters after a recession has began. So investors need to be aware of this, because that's a very important conclusion to make, which is we are probably not going to go back to 2% inflation on a durable basis until we go into recession. And so right now, there's a belief out there that inflation is decelerating, and that is true. However, inflation is still above trend, and comfortably above trend when you look at it on a delta adjusted Z-score basis relative to the 2015 and 19 trends in each of these time series. And so we understand that inflation is likely to continue moderating lower over the medium term, as evidenced by the current trends in the furthest leading indicators of the inflation cycle. But as we talked about earlier, it's likely that inflation does what it always does in this business cycle if we avoid recession, which is hit the bottom of the sine curve and start to reaccelerate higher. And as we progress throughout the first half of 2025, the difference between our current projections here on August 14th of 2024 and consensus estimates will start to widen. Now, again, our estimates can change between now and then, and we'll obviously communicate that to our clients. But we do see brewing market risk on the horizon sometime developing in the first half of 2025 associated with investors getting spooked again by the inflation monster. But again, we don't think that is a risk asset market and market participants have to price in today. Today, things are great. We're in a moderating upturn, and it's given the Fed the two thumbs up to hike to lower the policy rate and normalize U.S. monetary policy. So that's it. That's the business cycle. That we talked about essentially helping investors identify why macro matters, what the key indicators to watch are, and then help you guys understand how to accurately forecast the liquidity cycle, how to accurately forecast, and more importantly, pay attention to things that matter within the context of the business cycle.